Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Here are the three things that you need to know to start your morning. It was another big month for stocks. The S&P 500 closing at a 16-month high, and the mega-cap tech-heavy NASDAQ 100 posting its longest run of monthly gains since August 2020. But they weren't the standouts. In July, it was very much the Dow's month, summed up by that 13-day winning streak. Small caps were also on fire. The Russell 2000 ending July with a nearly 6% gain. In the global economy, bellwethers don't come much bigger than Caterpillar, the world's largest construction equipment manufacturer, warned of a fall in third quarter sales and margins. This after beating the street on the bottom line in the second quarter. Sales rose 21.6% to $17.3 billion, but investor concerns will surround its commercial business, which accounts for 75% of its customer base. And investors riding upbeat guidance from Uber. The ride-hailing giant reporting second quarter results that missed on the top line, but a sunny outlook as moving shares higher this morning. CEO Dara Khosrowshahi citing a big win in achieving its first quarter of free cash flow over $1 billion. Uber's net income landing at $394 million. That's compared to a net loss of $2.6 billion a year ago.
And it was another big month for stocks. The S&P 500 closing at a 16-month high. The mega cap tech-heavy NASDAQ 100 posting its longest run of monthly gains since August of 2020. Let's break down the gains in July, Brad. As we look at the three major averages, we actually saw the S&P 500 also up for a fifth month in a row. That's its longest winning streak going back to 2021. And all three major averages rising. I also was looking at some of the stats since earnings season began. Since JP Morgan reported on the 14th, we've seen stocks gain about 1.5% or so as measured by the S&P. So despite the fact that reported earnings are down around 7%, which was what analysts had predicted, stocks have held up okay.
Yeah, and when you mentioned some of the big banks, important to note that in terms of a sector performance, as we were just taking a look at the heat map a moment ago, some of the sectors, one of those sectors that performed best, and probably because we did get those bank earnings out early in front of the season, of course, as we typically do in the schedule of events in terms of when companies are reporting earnings. XLF, take a look at the financial sector. You saw that move higher by about 4.8% during the past month and during July, but not to be outdone by XLE and XLC. Of course, energy, that leading the pack, that was up by about 7.8%. And then additionally, you saw communication services moving higher by about, as I click out of this, by about 5.7%. Yeah, go ahead. Let's show that monthly look here.
That's 20 days for some reason.
There we go. And that gives us that full look at the month of July and just how quickly we saw communication services move higher. One of those big names, of course, that we continue to track, Meta, as we've continued to hear more about what their ambitions for not the metaverse necessarily, but more so for generative AI and how all of these different realms that they're putting together and realities, if you will, that they're putting together, especially with that launch of Threads, how they're gaining even more traction right now. So that, a little bit of a look at that. But as you mentioned, earnings, one stat did pop out to me, and this comes from the folks over at FactSet. S&P 500 companies with more international exposure, they've reported an earnings decline of 21% here. And so that particularly interesting, especially as we talk about a company, as we were teeing up the conversation for Caterpillar even today.
Yeah, so let's take a look at some of the other stats on the month, shall we? You mentioned Meta, so let's look at the NASDAQ 100 for the month here, and I'm going to equal weight it so we can see a little more clearly the big winners and losers. If this is choosing this moment to not go equal weight. All right, well, anyway, Meta up 11% on the month. Also, we had Alphabet up by about the same amount. NVIDIA continues to rally ahead of its earnings report, which isn't until the end of August, and so overall seeing some gains. And then for the Dow as well, it's just dead overall. So we're going to switch gears.
Making a left turn. Okay. Yeah. So the broadening out of the rally is real. And so the so-called Magnificent Seven, that gives way to wider gains. The Dow caught the attention this month, summed up by that 13-day winning streak, and small caps were also on fire. The Russell 2000 ending July with a nearly 6% gain. So let's get to our guest host, David Mazza, Round Hill Investments Chief Strategy Officer. David, great to have you here in studio with us. So let's kind of pick up where we left off there with what we've seen so far from this earnings season coming off of the month of July and what that sets up, at least for the tenor that we should be expecting to continue to hear from companies as we get into August too.
Yeah, there's really some notable things that we've learned this earnings season, right? There were some big expectations, and the expectations actually were to be on the downside because we know going into it, this was projected to be the third straight quarter of declines in S&P 500 earnings. We're in this so-called earnings recession. And as usual, we've seen companies beat. But what's different this time around is that companies beating on both the top and the bottom line, so on revenue and earnings, haven't necessarily been rewarded to the same extent as they historically have been. What investors seem to be paying more attention to is what does that guidance look like? What does that outlook look like for the third quarter and then out into the future? And I think this actually happened first last earnings season with NVIDIA when they put those blowout numbers and that blowout guidance, and we started to see it again. And that's why I think there's a bit of, traders are being a bit more discerning here about where this rally could continue to go.
As we look at what stocks have done during this period of time, Dave, they seem to be overall, yes, even though individual stocks are getting punished, the resilience overall is fairly remarkable, right? The bullishness overall is fairly remarkable. To what do you attribute that? And do you think it's going to continue?
Yeah, no, you're absolutely right. It's easy to kind of pick on certain days when markets are down or individual stocks are down, but overall, S&P 500 is up 20%. This year. And many folks, including a recent mea culpa by Mike Wilson of Morgan Stanley, were not predicting anything like this. We were not prepared. I think investors weren't necessarily prepared. One reason why, cash is finally an asset class again, right? And we've seen that again with 11 interest rate hikes since March 2022. We now have an alternative to equities. But even so, now we're seeing the equity market rally broaden out. Last month, all 11 GIC sectors actually were positive. As you were noting,
we were just looking at
exactly
the sectors,
before the board broke on you, we saw energy, the top performer, then communication services. And that's kind of a weird mix, right? Energy, very cyclical, yes. Related to usually earnings related to the price of oil. Communication services, more of a consumer tech-driven sector, and then banks with XLF. So I think that's a fascinating point where now we're seeing both kind of deep cyclical sectors, very economically driven, and consumer driven, actually propel the market higher.
I think we got gremlins everywhere this morning, Dave. Can you just slide your mic up your lapel a little bit? It went down. Keep going. Right there is fantastic. Okay, now we'll be able to hear you better. Go ahead, Brad.
No. I mean, what you were mentioning with regard to the broadening out that we've been watching as well. Now that we get into some of the names that have driven so much of this hype phase around generative AI, is there still a magic word that they can use that you expect them to implore with regard to trying to keep that same fervor alive for what their future growth may look like as well?
Well, so I think AI, particularly generative AI, first came into the scene late last year with the release of ChatGPT. And now what I think is interesting here is now we're seeing companies begin to take efforts to monetize that at the enterprise level. We know Salesforce has came out and said that that's a big part of their plans. Of course, Microsoft has now released premium services. And on any given day, we're particularly this earnings season, now investors are reading through and saying, well, what companies are beginning to use generative AI? It's really interesting. We've been using it in our work to help with a lot of different efforts. And to me, it's like having a co-pilot, or it makes me a super user. It's been a long time since I was as strong of a coder as I'd like to say I was, but now with the help of basically an assistant on the generative AI side, I can compete with some of the younger folks on my team in the same way, which is fascinating. So imagine doing that across a wide range of industries and a wide range of applications. So net, I think generative AI will remain a large theme. Of course, we have some reporters in the space. Let's see if Apple even decides to mention it at all. They're pretty cagey about using certain terms, the metaverse being one that they had avoided for some time. But going forward, I don't think that's going away at all.
I want to turn to another area that's sort of maybe a symptom of the bullishness that we're seeing in the market right now. And it's something you know a lot about, and that's meme stocks, because you guys have a meme ETF. I was struck yesterday. I was writing the morning brief for this morning. I was looking at the sort of month-end stats. And as I was looking at our trending ticker page, I was struck by how many meme-ish stocks there were. I think Nikola was on the list. Palantir, which has kind of gotten memey, was on the list. Tupperware has been a huge, random performer that we have seen over the past month. Year to date, not done much, but you can see the climb there on the right side of that chart. What does that tell us, if anything? And is it still retail investors in that stuff, or is it actually institutional investors now who are in the memes?
A few things to note. So on the meme side, we have the meme ETF, and the ticker actually is meme, so MEME. And we've actually seen a large spike in trading volume over the last few weeks. And this was an ETF that was effectively left for dead. There wasn't a lot of interest in it. And now we've seen retail investors in particular and traders come back into the market. Some of this is happening to be the broadening out that we're seeing, right? Interest in names that aren't just the Magnificent Seven. In some ways, that's healthy. The meme ETF is up over 60% on a year-to-date basis. To me, this was a symptom that perhaps everyone got too bearish last year. I'm not saying it's all clear on the economic front. That's something we can talk about. But I think we got too bearish, too of the belief that the Federal Reserve would cause a recession. Right then and there, stocks would crater even more. And now what we're seeing is if we're seeing meme stocks, which are a different basket of meme stocks than they were many moons ago, propel higher. I think that shows that we're seeing broader interest. And again, this theme of broadening out from an equity market perspective.
Oh, that's really interesting. I usually don't think of the memes when I think of the broadening out that a lot of people talk about, but it makes sense to think of them in that way. Speaking of broadening out, hang on for just a second, Dave, because we are going to turn to another topic, and that topic is Caterpillar. Caterpillar shares are popping this morning. High infrastructure spending driving the company's profit higher. The construction equipment company seeing revenue increase by 22% to $17.3 billion. Adjusted profit per share of $5.55, which is considerably higher than estimated, as you see there. The company also saw higher operating profit margin compared to a year prior, 21.1%. David Mazza is still with us, Roundhill Investments Chief Strategy Officer. These numbers from Caterpillar were pretty impressive. I was struck by that profit margin, which was an expansion from under 14% to over 21%, which is that's a big increase in profit margin here. A lot of all of this, though, I saw was coming from pricing. Volume was increasing, but a lot of it was coming from pricing. So I just wonder, as we look at Caterpillar, again, what it tells us.
Yeah, and it's telling us some conflicting signals, which is to me one of the reasons it's a bellwether is it's telling us why it's so conflicting in this market environment. Two things you noted: a lot of the great earnings that came and the revenue came from pricing increases. So actually, Caterpillar was able to pass on higher prices to continue to help their margin to their consumers. Right, 75% is things like machinery. If we look, though, at the regions, that's when we start to see some big differences. US, North America, relatively strong. China, and the outlook for China remains weak. And we know that's been a big question mark, right? What's going to happen with the Chinese economy? We're having inflationary pressures. So to me, Caterpillar numbers and the rear view perspective, the revenue earnings, really great. Maybe perhaps one of the reasons why the stock isn't necessarily popping. It was actually the best performing Dow stock in June, had another great month in July. So some of it could be a bit of buy the rumor, sell the news in this example. But what's interesting is on the outlook perspective, at some point, the slowing in China and the slowing in Europe has to catch up with names like Caterpillar. We haven't seen it yet, but looking ahead, their forecast was not necessarily as rosy as some might hope.
How much from those international segments can we extrapolate from Caterpillar and apply to some other companies that are going to be reporting earnings? I mean, we were citing that FactSet data earlier, talking about S&P 500 companies that had more international exposure and the reported earnings decline that they had been seeing. So kind of if we look through Caterpillar's numbers here, we've got Apple coming out later this week. We've got some other major chip makers that have exposure internationally. How much can we extrapolate from what Caterpillar is telling us about their international and China-specific business and kind of layer that on to what the expectations are for the rest of this earnings season too?
I'd say likely a lot. And the reason being that it's likely a lot is for the fact that we are seeing this bifurcation. It's been a perennial issue that the US economy and US markets have outperformed internationally, especially if I look at Europe and then emerging markets. Look at a chart comparing the emerging market index to the S&P 500, and it's been a one-way trade essentially for over a decade. Now, with normalization of interest rates from an economic perspective, to me, one of the themes that I'm seeing is that lets winners and losers start to emerge. It actually lets winners and losers, bulls and bears on individual stocks kind of fight it out without the fact that just low rates will actually kind of propel everything higher. But what's interesting here is that there is going to be names, and Caterpillar is indicative of one of them. I think some of the other automobile manufacturers, and others will start to see, hey, what's going on in the US versus what's going on outside of the US, and companies likely are going to be punished more than rewarded more, right? And so that's kind of an interesting theme. So I would be careful here with individual positions, but also extrapolating short-term moves, because we've seen such a run-up, and we're heading into one of the worst periods from a seasonal perspective. July was again, kind of gave more data to the bulls that for now, with the kind of flow of funds and the sentiment, remains on the positive side.
Well, speaking of being punished, that brings us to our next subject, which is travel, and in particular JetBlue. We're getting a read on the consumer and where they're traveling in a number of different travel earnings reports. JetBlue shares are up by 7%. The company slashed its outlook for the rest of the year and attributing that move to a shift toward international travel. It is more domestically oriented. It also lost its partnership with American Airlines. We also heard from some other travel companies, though, where things do look better. Marriott, for example, also reported that company beating estimates, but the shares are trading a little down. And Norwegian Cruise Line raising its earnings per share forecast for the full year. But those shares are getting punished too. So go figure. We'll see. Maybe there's some other stuff in there that is causing all of that. Dave Mazza is still with us, Roundhill Investments Chief Strategy Officer. I know you travel quite a bit because you're based in LA, so you're flying back and forth. So it's interesting to hear to see what looks like anecdotally a travel boom all around us, and yet it's not necessarily helping all of the travel companies equally.
Yeah, no, really some interesting tidbits here. So I was actually traveling on vacation a few weeks ago to Europe, packed flights, packed hotels, couldn't get around. When I traveled most recently domestically, pretty light. And I think this is perhaps indicative of what we saw out of JetBlue most recently. Alaska also was in that camp, compared to perhaps something coming out of Marriott, or even news of United creating all these mega routes. I've been on a plane for over 16 hours, but they're signing up all these 20-hour flights and everything of that nature. And what's interesting is, again, we're seeing bifurcation at the individual company level. I think JetBlue, of course, also hurt by issues with the Northeast Alliance that was broken up, and then the requirement, like other airlines, to pull back on some of this Northeast travel due to limited air traffic controllers. But it tells us that I think we need to be careful when we see pictures of packed airports or social media saying everything's fine. Those tickets were probably booked weeks ago or months ago. And so if people are looking out and saying, hey, I'm more concerned with what's going to happen around Thanksgiving or the holidays this year looking ahead, and that I think we might start to see a pullback. American Express released earnings a few weeks ago, another sort of bellwether for the consumer. Something fascinating to me came out of that, saying they're starting to see evidence. Again, these are folks with considerable incomes who have platinum cards and the like, pulling back on some hotel and airfare, but increasing spending at restaurants, both for takeout and in person. So to me, that's a sign, again, early sign, that maybe, again, there is some of a pullback of some of these big ticket spending, but people are still feeling pretty good. They want to get out of the house, want to go to a nice dinner. So that's where they're spending, as opposed to booking that vacation around the holidays or to Europe next year.
Which is really interesting, considering American Express saying that, but has a little bit more exposure to the corporate side too of spending. Meanwhile, you've got MasterCard that came out last week that was essentially saying, yeah, travel spending is still looking strong here, that really giving a lot of credence to what we had been hearing from some of those travel CEOs. Speaking of travel, let's talk a little more accommodations here. Opposite over at Marriott here, when we think about the company out with earnings this morning, lifting their outlook on demand for international travel and international revenue coming in better than expected in the second quarter for Marriott. They also added over 33,000 rooms globally during the second quarter here. Want to get your perspective around Marriott and the accommodation space as of right now, as travel continues to at least show no signs of slowing down immediately. But at the same time, you've got to think about how much all of these companies are spending to either bring on more capacity or just to retain that consumer too.
Yeah, I think, again, overall theme is for now. And again, this has helped the economy in aggregate this year, has been resiliency of the consumer, resiliency of the American consumer that has propelled certain companies higher. Marriott's a great example of that, and particularly noting on that international side. So it's fascinating that on the travel side, companies with greater international exposure are benefiting. But then, to your point, in aggregate, companies, perhaps in the other types of consumers, are actually not being rewarded as much, in fact, because their earnings are not as robust for other reasons. So again, American consumer bringing cash overseas, spending more there, benefiting companies exposed. But perhaps we're seeing companies and local sort of Europeans or folks living in Asia not spending as much, not confident as much.
And on that note, we also should note for our viewers out there, don't miss Yahoo Finance's interview with Marriott CFO Leeny Oberg. That's coming up later today in the 3 o'clock hour. Dave, while we have you here, Meta, we got to talk about this. They're looking to expand into the AI universe. The platform is reportedly launching chatbots with a range of personalities as soon as September, according to the Financial Times. So what does this mean for the future of the metaverse? David Mazza, Roundhill Investments Chief Strategy Officer, still with us. What does this mean for the future of the metaverse? I mean, they haven't necessarily said that they're just ending all ambitions to bring that to life. They're still trying to make that a reality.
Yeah, I don't think they're ending this at all. They're still spending billions and billions of dollars from a CapEx perspective.
But AI is the flashy thing.
Correct,
right
to bring that to life. But right now we are seeing the sort of near-term reality and focuses of a company like Meta on generative AI, because it's a bit more attainable, it's a bit more usable today. We could log on and start using our like I said, chatbots for consumer applications, for corporate applications. Even among our ETF suite at Roundhill, of course, we have the Metaverse ETF, ticker METV, but we also have a generative AI ETF, Chat. And Chat is seeing considerably more interest right now than METV from a flow perspective, even as performance of both is really strong. So I think that's a bit indicative to me of saying, well, what's the near-term focus? And of course, that's generative AI. What can people use? What can they feel today? And the metaverse gets kind of pushed out a bit further. Doesn't mean it's not necessarily going to happen, but it's a theme that's maybe not as accessible or, again, attainable for companies who are focused on producing results this quarter or the next quarter.
Yeah, I was going to ask you, which is where are you seeing the most inflows right now? Is it in that generative AI ETF among the suite of ETFs that you guys have?
I'd say by a wide mile. So the ticker of that is Chat, CHAT. And that's one that we actually introduced in May of this year. And since then, we've seen really strong trading volume and really strong inflows. And I think some of this is because it's the first ETF and only ETF that provides pure play exposure to companies involved with generative AI. So in that ETF, you're going to see names, of course, on the semiconductor side, like NVIDIA, but also companies like a Microsoft that are involved with creating large language models and creating the tools that consumers and businesses can use to integrate generative AI into their workflows or just day to day.
Yeah, we'll keep watching it. All right, Dave, good to see you. Thanks for coming in. David Mazza is Roundhill Investments Chief Strategy Officer. Appreciate it. We got much more markets action coming up. Stay tuned. You're watching Yahoo Finance.
To this earnings season.
Yeah, I'd say we're about 50% through earnings season, and the theme has really been about 80% of the companies have beat earnings on a bottom line basis. So it does feel like the trend we saw in Q1 continues through Q2, Now, we're still down negative 7.5% or so thus far year over year on an S&P earnings growth basis, but slightly better than expected, and the trend is supposed to improve in the second half of the year. So I'd say net, the good news is we are seeing better margins and better earnings overall in the second quarter.
We have earnings from pharmaceutical giants Merck and Pfizer here this morning. So let's talk about what they reported with our Anjali Kamlani, who covers healthcare. Anjali, what stands out to you from these two companies?
Well, definitely a lot on the table for both companies, as you mentioned, both really big. But I think what's really interesting is the impact of the COVID decline in demand on both companies. Let's start off with Merck, which reported a 3% increase in revenue, but that is ex-COVID is 14% increase, which is pretty huge. They've also upgraded their guidance by about $800 million for the year. And let's not forget, they also acquired Prometheus. So that has had an impact on their quarter. And in addition, for the rest of the year, they did bring in $15 billion in revenues. Interesting to see that decline, like I mentioned, on the COVID product. They specifically only have the treatment, which saw an 83% decline. Meanwhile, positives are Keytruda and Gardasil really driving the profits there. Gardasil is that HPV vaccine. They actually saw strong demand ex-US. So that's, you're looking in China, for example, a really strong market for them. And then their blockbuster, of course, Keytruda. They do have that LOE in 2028, so that loss of exclusivity that they're expecting. And they are prepared for that generic competition then. And that sort of is where Prometheus fits into that pipeline. So that small amount of impact from both the COVID part and the acquisition is kind of what's weighing on them today. Meanwhile, Pfizer, we know they are the number one for that COVID vaccine and as well as the treatment. A lot of impact there, 53% revenue decline, again, because of such a strong year last year based on just the COVID products. So without that, they've seen a bit of an increase there and in the revenues, and they did have to reduce the outlook for 2023. So that has been something that the analysts have looked at when it comes to what that means. It's a reduction, of course, based on COVID, but also we saw them kind of trying to boost their pipeline for the short term with Seagen and that big acquisition. So they're also looking at long term what their pipeline is going to look like. So all told, really a mixed quarter for Pfizer, strong quarter for Merck, really, broadly speaking. And also another note for Pfizer, they did get their approval for their RSV vaccine for 60 and older, but they're seeing possibly a little bit less of a market than they expected based on what they think the CDC is going to guide for it. So while they do see more approvals anticipated for the second quarter, it's still looking, like you saw on your screen just now, a little bit mixed for Pfizer, but good news for Merck.
Yeah, definitely. We'll continue to watch them. Angelika Milani, thank you so much for giving us the big picture on those two stocks as we continue to drag ourselves through earnings season and the many, many numbers that we are sifting through. Very helpful to get that information. We're just setting up for the opening bell on Wall Street in just a few moments here. And we are sifting through a lot of earnings news. That is really where investors' attentions are focused right now. We're ending the month of July on an up note for 5 straight up months for the S&P 500. Now heading into August, which does tend to be a down month for stocks, by the way, in recent history. So we'll see if the rally continues. So let's get a check on these opening prices now, sponsored by Tasty Trade. And it does look like that we are setting up for maybe a little bit more of a mixed picture here based on some of the earnings numbers that we have been getting. We talked about some of them earlier. Caterpillar coming out with a beat, but also a little bit of a disappointing forecast. JetBlue cutting its forecast. So we've got the NASDAQ leading declines today, down by about 0.5%. Of course, Brad's over at the touchscreen looking at things in more detail.
Yeah, indeed. Let's get some Leo season energy on these markets, folks. Let's get it ripping and raving to the upside. At least for the Dow, it's flat, just barely to the upside right now. 0.03% in gains. We'll see if we can cling to those. Let's put that on a chart view for you. And why not give you a little bit clearer view of how that's been moving over the course of, let's go 1 month for you, just to populate this chart. Okay, there you're seeing that move over the past month, up by about 3.4%, flat out the gate here today. NASDAQ composite, as we mentioned, that is lower right now by about 0.5%, a little more than that to start off today's activity. S&P 500, you're seeing that down by about 0.3%. Since we mentioned the S&P 500, let's take a look at some of those sectors. We've got 11 for you loaded up here on the screen. And as of right now, we are seeing a lot of red. More laggards than leaders. However, Staples, that is saying, hold my beer right now. We can get in the green. That's up by about 0.1%. So Staples holding on to gains. Utilities trying to make up its mind, waffling out of the gate here this morning. Got a little bit of a wobbly tire. We'll see if it can straighten that out. XLB, though, right now you're seeing materials pulling up the caboose. That's down by about 0.7% here. Let's take a look at the tech-heavy NASDAQ as we've got 2 big names that are going to be reporting earnings this week. I mean, a host of other companies as well will be. But investors certainly going to have their eyes on Apple and Amazon here out of the gate today. You've got that down by about 0.2% for Apple, Amazon lower by about 0.5%. We were mentioning some of the other earnings related movers here out of the gate. You've got a lot of red on the screen, and then I'll just put this on an equal view here for the NASDAQ 100. Pulling up the caboose, you've got Lucid. Lucid is down by about 3% out of the gate this morning. And then a company that we don't talk about a ton, IDX. X is the ticker symbol. That's down by about 5% here on the day. So we'll continue to keep a close eye on all of those, and we'll just ride out with a quick look at the Dow. As we had mentioned, Caterpillar, one of those Dow names, and you're seeing that open up higher by about 3.4% as we were breaking down earnings that came out earlier this morning before the start of today's trading activity. Caterpillar on those earnings leading the Dow components as of right now, Julie.
Yeah, and IDEX Labs, by the way, out with earnings. It looks like the numbers actually beat, so the shares obviously taking a hit here today. Let's talk about some other earnings, shall we? Zoom Info, one of the movers we're watching, and it's down by 23%, extending declines after cutting its full-year guidance for revenue, free cash flow, and earnings. It did report a beat in its second quarter results, but the company explaining in its earnings call that its growth could be offset by deterioration in buyer sentiment and behavior. Basically, this is lead generation and assistance software. That's what Zoom Info does here. Deutsche Bank cutting the stock here, its recommendation on the stock, saying there is a, quote, persistent lack of visibility. It's cutting it to hold from buy. So definitely some pessimism around the stocks this morning.
Yeah, indeed. And as we were even taking a look at the shares, if we're able to zoom out for a kind of broader view of how I tried. You know, you connect the dots here. That's all we could do. Zoom Info stock over the course of the past 3 months is down by about 10, 11% here. And you look at that year-to-date performance as well, having a dismal performance. It's down by about 34% on that scale. Now, larger question for some of these B2B companies as of where they can continue to generate demand during a downturn, at least in some of the cost restructuring for some of the portfolio clients that they would have leaned on in the past. Typically, companies would kind of acquire to grow, but Zoom Info and the cash that some companies have been able to deploy and add on to their service offerings, Zoom Info not necessarily in the same kind of instance as you would see a Microsoft, as you would see a Salesforce or an Oracle or even an Adobe, even if some of those deals get scrutinized and don't come into the fray. Zoom Info in a much more difficult position to try and make some of those big cash or cash and stock acquisitions that would allow them to go back to that portfolio client base and say, hey, we've added on this additional feature or this additional service here. So we'll see what more the company has to say surrounding the results as well as where they're going to initiate that demand generation here in the future too. Let's also talk about Uber shares. Uber shares jumping this morning, as Destiny's Child would say, after its second quarter results show that the company posted its first ever GAAP operating profit results for the rideshare giant. On the top and bottom line were mixed, with revenue missing expectations at $9.2 billion and adjusted earnings per share beating estimates at 18 cents a share. Joining us now, we've got Steve Zhang, who is the Kindred Ventures founder and managing partner here. Steve, great to have you here with us this morning. First, got to just get your kind of top line read here on Uber.
Sure. I think this is a seminal quarter for the company in its entire history. It being $1.1 billion of free cash flow in this last quarter, a huge milestone for the company. Also, on a GAAP basis, an operating profit of over $300 million. So it's well on its way to the next chapter of its story, which is as a profitable company, as not only a technology company but a high executing operating company. And I think this is something that the company has been looking forward to for the last 14 years since its inception.
And you were one of the early investors in the company, we should mention. So you're well acquainted. What do you think Uber has done right, particularly in the last 2 years under Dara Khosrowshahi, to sort of get it to this point?
Sure. Prior to Dara coming on board in the company 6 years ago, actually now, the story of the company was growth and innovation. And I think after going public under Dara's stewardship, the markets, Wall Street investors wanted profitability. They wanted to see that the pioneer of the sharing economy marketplaces could actually be profitable. And I think Dara has done that now, and has proven that. And that's really important for this company in terms of the next stage. The growth that we see today is measured, right? It's measured by the need to be profitable, not only gross profits, but operating profits and net profits. And I think the challenge through COVID was to keep the ship floating and moving forward. And now that the economy is rebounding, Uber has become not only a utility and an operating system for transportation and logistics, but it's also somewhat of a bellwether and a marker for how the economy is doing. So, my belief is that we are not in a full recession, that we are actually doing quite well fundamentally, at least in the U.S., and we are on the up and up. And I think if you look at Uber's performance over time, it reflects that. And so the goal of the company has been to reach this profitability. I think the next step here is to see how we can turn on growth again. And I think growth will come in several forms. I think growth will come in international regions where Uber is strong. Again, Uber is the only global ride-sharing and logistics company that is of note. Right now, Lyft is only domestically available. DoorDash is, on the delivery side, is only domestically available. Its main international competition, Didi, is quite hampered right now with what's going on with China and the growing pushback internationally to their growth. So I think Uber is well positioned today. India is a bright spot. I think there's a huge opportunity in India for Uber. I think Uber's early investment internally on its own systems and marketplace using AI will continue to pay off quietly and will become a little bit more loud and pronounced in the moving future. I think its divestitures of its innovation businesses in terms of self-driving cars and aviation, I think that was probably smart in hindsight, in that the markets have been pretty brutal on those companies. I think as the stock price goes up at Uber, I'd like to see more reinvestment of the company into those innovation areas, including AI, including self-driving vehicles. You see great partnerships right now with Waymo that are at the very beginning. I'd like to see more of that, as with Uber at the center nexus of self-driving vehicles in every major city in the US. So there's a lot of growth opportunity, a lot of headroom still. The business today has 137 million monthly active customers. I think that's just at the very beginning of a growth curve globally.
I love the perspective that you added there, a couple minutes ago about Uber as an economic bellwether here. But, even more as you think about some of the growth and their role that they play in the economy, how much as a company do you expect them to spend in order to really elicit that growth that you were talking about in some of the key areas of the business? And what does that mean for pricing strategy too for consumers?
Yeah, I think the pricing strategy has pretty much settled down. I mean, there was a price war happening between ride-sharing companies over the last 3-4 years that was pretty heightened. I think the thing that Uber has done well, to answer the prior question again, is Uber really focused in on the supply side of the marketplace. Ride sharing and delivery, it's a supply side marketplace dynamic for sure. I mean, it's been proven over the last 6-7 years that this has been the case, and that's why you saw a lot of the pricing wars between driver subsidies and other marketing expenses like that. That has all settled down. Lyft is hampered right now and has reduced costs, and that has stopped there. Didi, same thing as well globally. So I think right now, as I think Dara just went on and on the air and said, hey, look, we're seeing pricing really settle down. We're competing now on brand and service quality. And I think that's the name of the game. The growth that you'll see moving forward, I think, comes from just day in, day out operational excellence. The company has done a really good job of cost cutting. They've done a great job of servicing drivers. The Uber One program allows for customers of delivery of Uber Eats and Uber ride sharing to be able to have an elevated experience. I think more and more of these efforts to take a lot of the multimodal transport, a lot of the cross-selling between services and drivers, having drivers graduate from being a Uber Eats driver on the delivery side into ride hailing, which is much more profitable for the drivers. I think that, this constant progression is really important for the growth of the business. Outside of that, technology innovation needs to be stoked again. I'm sure that I know that the management team is already focused in on that. That's a 3 to 5 year story arc. We'll see how that plays out, but I'm really excited to see equity value increase, balance sheet strength increase, and to see reinvestment into those technology innovation areas like AI, also international development as well.
I know that the company's also talked about focusing on grocery, and that as a growth area. Does that make sense to you? Do you think that's going to be a big area of opportunity also?
I think grocery as a standalone business is not a great business today. I think there were a lot of COVID tailwinds that came into grocery and delivery. I think the unit economics today as a standalone business aren't great. But I think that as a part of a larger multi-service operating system or a platform, I think it does make sense. It increases average order values. It increases ARPU of a Uber customer today. So I'd like to see more expansion in that. I think, is there an acquisition available to the company? I think there is. I think we have to see buyer and seller prices kind of come into better alignment. But I'd love to see that. That's an area of growth in GMV that would be tremendous. I think that fits into the story of, is Uber the operating system for all of these things in your daily life that require transport or logistics? And so, and in terms of international growth, I think that's also a huge greenfield opportunity.
Steve, thanks so much for the time here today and helping us break down some of the Uber results as well as the forecast and perhaps even the growth pathway here. Steve Jiang, who is the Kindred Ventures founder and managing partner. Appreciate it.
Thank you for having me.
Definitely. All right, guys, coming up, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Is recession still on the table? It seems like soft landing is purely in the cards right now. Is that true?
Yeah, look, we couldn't have asked for a better Goldilocks type scenario, at least for now. We're seeing inflation moderate, and that's not only headline inflation, we're seeing early signs of core inflation moderate. This comes even as economic growth is holding up better. So you can have an environment where growth in the US is still in that above trend 2.5% range, inflation moderating, and by the way, earnings holding up better. And we have a Fed that potentially, and really global central banks, thinking about stepping to the sidelines. We do think this year, pivoting lower to rate cuts unlikely, but next year, the Fed has already told us that they may be considering cutting rates. So you have an environment where interest rates may be headed lower, inflation is trending in the right direction, and growth is still holding up. That to us is a soft landing.
The Dow took the spotlight in July with its 13-day winning streak, but another benchmark also saw some big gains. The Russell 2000 closed out the month up over 6%. Yahoo Finance's Jared Blickery joins us with more details here. Hey, Jared.
That's right. I haven't given enough attention to small caps, so here we're going to do the NASDAQ 100. That's full of large mega cap names that did really well this year versus the Russell 2000, which languished a bit but then caught up. So let's just kind of map out the year that was. Here's the beginning of the year. Everything took off together. Then into the mini internet banking panic that we had, we saw small caps take a real hit while the NASDAQ 100 and the mega caps just kind of took off. Now, the small caps, they do house a lot of the regional banks, so that's in part why they were down so much and why they were kept underwater. However, you take a look at what's happened over the last 2 months, and guess what? Russell 2000 has shot up 12% versus the NASDAQ 100's 8.5%. And this just really reflects the broad-based rally that this rally has become. However, I was reading a Barclays note, and before I get to this, I was reading a Barclays note, and they are arguing that the pain trade is still into continued rotation. So not necessarily the growth trade that has worked so well this year since the beginning, but now the catch-up trade, the cyclical, the values. So here is the small cap, the Russell 2000 versus Goldman Sachs commodity index. And commodities have picked up as well. And by the way, I'm going to be charting all these things with Mish Schneider in the 11 a.m. hour, but I thought we'd just take a little look at this first. Here's the year to date on all of these, the Russell 2000 and the Goldman Sachs commodity index. You can see commodities still under a little bit of water here, but if you draw a trend line, they are just starting to perk up here. And this is also about where they are crossing their 200-day moving average, not shown. So put it all together, small caps finally joining the party. Nice to see that. There may be additional pain trade to the upside here. And I'll just go to our heat map to show you some of the rotation that has so far taken place. Now, these are the S&P 500. So these are large cap sectors, but we've seen a lot of rotation and into the smaller caps as well. That's taken on a similar path. In other words, the same sectors here. So here's the sector action from the beginning of the year. Mega cap sectors, those are the big gorillas in the room. And here is the 2-month look. And now you can see industrials in the lead. So that's that cyclical trade picking up. Then energy, then consumer discretionary. That's really a retail story. I was talking yesterday about how Kohl's and JWN, Nordstrom is really two of the best performing stocks in the retail sector. That's brick and mortar. That was not the case at the beginning of the year. Then you got materials. That's a soft dollar story, and financials. All of this predicated, though, on rates kind of staying where they are, or at least not moving too much, because one thing we've seen is a decrease in volatility. Here's the ICE B of A move index, kind of like the VIX of the bond market, as I like to say. You can see it's at the lower end of its yearly range. This is a year-to-date chart, but you take a look at the 5-year, it is still clearly elevated. Let me just put a line chart here so you can see it a little bit better. Very much elevated, still in the about the midpoint of its range. And then you compare that to what's happening with the VIX. VIX already down here. So my biggest concern is an upset in the bond market. And by the way, I got Macro Alf stopping by in the 11 a.m. hour too. He's going to be off the top, and we're going to talk all things macro. Lots of Fed stuff in there too, guys.
Looking forward to it. Thanks, Jared. Appreciate it. Well, Tesla reportedly created a secret team to block drivers' range complaints. In an investigative piece by Reuters, the EV giant allegedly deployed the team because its service centers were inundated with appointment requests from owners who had expected better range performance. According to the expansive article, Tesla employees have been instructed to crush any complaints about the EV maker's poor driving range. The investigation alleges the company quietly created a diversion team in Las Vegas to cancel as many range-related appointments as possible. The source cited says the directive to present rosy range projections came from Tesla chief executive Elon Musk himself, and Yahoo Finance has reached out to the company for comment on the article. Let's bring in the author behind the investigation. That's Steve Stecklow. He is global investigative reporter at Reuters. This definitely caught my attention when it came out late last week, Steve. Your in-depth reporting, but before you even get to the reports of range anxiety or range concerns, first, as you talked about in the article, the company, if you can't entirely trust necessarily the range that is reported by the vehicle itself. Can you talk us through that?
Well, yes. What our reporting found was that for years, Tesla has exaggerated its range. And about a decade ago, they decided to rig the software that shows the range numbers when you're actually driving in the car. So it would show you what was described to us as rosy estimate, and again, it's like while you're driving, it's showing you this is different from the window sticker. But eventually, as you mentioned before, this led to the company being inundated with thousands of complaints from people complaining that they're not getting the promised range that was advertised.
And so if we're understanding correctly, the company were then diverting these complaints when they received them and then squashing them, or just kind of making sure that they fell out of the system?
Yeah, so they created this team, as you said, it was in Nevada, and its sole purpose was to cancel appointments that Tesla owners had made complaining about range. The way it works with a Tesla is you could book an appointment using their app on your phone. And until recently, you could go on there and say you had a range problem, and then it would present a calendar and you'd book an appointment. So suddenly they had all these service appointments. So they decided to form this team. And again, what these people were assigned to do was to try to cancel as many of these as possible. So over time, they were ordered to, if they tried to call a customer and the customer didn't answer the phone, they would close the case. If the customer answered the phone, they were told speak no more than 5 minutes. Eventually, they changed the app so you couldn't book an appointment over the phone at all. You were told that Tesla would contact you. And that's when suddenly at that point, they were getting like 2,000 complaints a week. And all of these were sent to this diversion team. You might be interested to know on the diversion team, the people on it were rated based on how many service appointments for range that they canceled on a daily basis. And whenever they canceled one, someone had a xylophone with metal keys in the office called a metallophone. And someone would strike that. They'd put their phones on mute. They'd stand on their chairs and applaud to celebrate that whenever they canceled a service appointment.
I mean, this was something out of Boiler Room. I think the movie, when I was reading your article, Steve, that's the vibe you sort of got here. What's interesting to me is that Tesla has been selling a lot of cars, right? It hasn't necessarily hit all of its metrics, but it's so fascinating to me that if this is such a big issue, that it hasn't affected it more acutely. I mean, this seems like a pretty big problem.
Well, range is a big selling point on cars, and Tesla's advertised some of the longest ranges in the business. And also for people who are deciding whether they should get an electric vehicle at all, range is one of the key factors in their decision. So Tesla has continued to advertise these long ranges. Just last month, they were required by the South Korean regulators, who fined them about $2.1 million for exaggerating the range on their websites in South Korea over a several-year period, primarily for not disclosing how much cold weather can affect range. The South Koreans found, and others have too, that with an EV, cold weather can reduce the range by almost half or more. So Tesla was required to post on its website a disclosure in which they admitted they had falsely advertised in South Korea. And at the bottom was several executives, including Elon Musk.
Steve, really great reporting and investigative journalism there by you and the team. Steve Stecklow, who is the Reuters global investigative reporter. We appreciate the time breaking down the story for us.
My pleasure. Thank you.
Thanks. All your markets action straight ahead. Stay tuned, everyone. You're watching Yahoo Finance. Have you tried pickleball yet?
You know what? I am a pretty avid ping pong player. I have not transitioned to pickleball, but I'm told if I'm good at ping pong, I can make the transition to pickleball pretty seamlessly. So that may be my next step, something maybe by the end of the summer I will be able to say yes to, but not yet.
It's like life-size ping pong, right?
Yes, and the ball is bigger too, which I feel like that could be an advantage as well. So.
Big plus right there. Thanks so much for playing, Mona. Welcome back, everyone. Just after 10 a.m. in New York City, this is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into today's trading activity. Let's take a look at how stocks are moving right now. Looking at the S&P 500, things are a little mixed to start the month of August. We're going to have to get that into the right. Off to a hot July, after a hot July rather, things could be cooling as stocks do tend to underperform in the month of August. Investors are also anticipating job openings data, which should be hitting right about now.
Yes, and we'll talk about that in just a hot second. But first, let's talk about some individual movers. We're watching shares of Gap this morning. They're up almost 4%. The stock moving on an upgrade from Barclays. Analyst Adrian Yee boosted the stock to overweight from equal weight. She gave it a $13 price target, citing potential for business improvement.
And Rockwell Automation is under pressure this morning after reporting a third quarter results that ultimately missed some of the expectations there. The company slashed its sales guidance for the year on supply chain issues linked to a new U.S. distribution center. And now it expects sales growth of 14% to 16%. That's down from a prior outlook that saw growth of up to 16.5%.
And we are also following Transocean after its earnings results missed Wall Street expectations. The rig operator, rig is also the ticker, who reported an adjusted loss of 15 cents per share in its second quarter. It did have a surprise revenue beat due to increased activity for drilling rigs, but investors are not buoyed by this, with shipping demand below pandemic highs. As promised, let's talk about what's going on with JOLTS here. Job openings at about 9.58 million in June. That is a hair below the 9.6 million that was estimated by economists here. So showing, perhaps as expected, a little sort of baby slowdown in demand for jobs here. At the same time, we got ISM manufacturing showing continued contraction in manufacturing activity. That read coming in at 46.4 for July versus the 46.9 that was estimated. Prices paid really moderating here, or more moderate than expected, although accelerating from the prior month. But overall, nothing really sort of too divergent from the expectations of what we are already seeing for the economy.
Yeah, looking across some of these sectors for the job openings here, job openings actually increased in healthcare and social assistance by about 136,000 jobs in that part of the economy. And then in state and local government, excluding education, you saw that move higher by about 62,000 jobs. However, job openings did decrease in transportation, warehousing, and utilities. That was down by about 78,000. And then state and local government education, that was lower by about 29,000. Federal government also down 21,000. So that, just to look at some of these sectors here. And then in hires, they also note the number of hires decreased by about 326,000, while the rate was little changed at 3.8%. Hires decreased in durable goods manufacturing. That was down by about 54,000. Then finance and insurance also down by the same marker there.
Yeah, at the same time, that ISM manufacturing report, 9th straight month of contraction here, but measures of new orders and production did improve in July. So a little bit of encouraging signs underneath the surface. Let's get some more on the economic picture right now. Will the job market resilience continue to be a tough pill for the Fed? That new data showing that job openings in June did miss street expectations by a touch. Joining us now is Chris Rupke, Forward Bonds chief economist. So Chris, as we talked about, a little bit of softening, but still, I mean, that's a lot of openings still, isn't it?
Yeah, there does seem to be that. This seems to be one of the reasons why the labor market remains quite tight. Kind of a shortage of economy here. Maybe it's due to the baby boomers born 1946 to 64 dropping out and no one there to take their place. For whatever reason, the labor market joblessness isn't going up like the Fed forecast.
I'm taking a look at some of the layoffs and discharges. That was little changed during the month here, Chris, at about 1.5 million. And then additionally here, the quits rate, that decreased to 3.8 million here. If there's, and the percentage basis there, 2.4%. So if there's anything that you extrapolate from those numbers as to where there is still an environment for employees to find work elsewhere, what would that signal to you about the continuance of a trend within the labor economy?
Well, it looks like the trend's going to continue. It seems like this labor market's going to continue to be quite tight. The million-dollar question is whether or not that keeps the Fed, from tightening further here, and whether or not this underperformance of, if you will, of demand in the economy allows inflation to fall closer to target. At the moment, core PCE inflation's running 4.1% in June. The Fed's target is 3.9 at the end of this year. So it's going in the Fed's direction without the economy suffering too much, at least in terms of job losses. The only thing that kind of worries me right now about the outlook was apparently the Treasury borrowing needs have gone up dramatically. That was released 3 o'clock yesterday afternoon. It's probably helping to send 10-year Treasury yields higher today. That's one of the factors, I think, higher bond yields that could put the kibosh on the stock market rally, potentially leading to weaker growth down the road, weaker capital expenditures, something like that.
So just to walk us through that, basically there is going to be a lot of supply coming to market of government debt. You think there's going to be demand for that government debt. So we're going to see those prices go up and yield. What are we going to see happen to yields as a result of all that? I mean, in other words, the supply coming to market there, what are the dynamics that are going to be at work?
Well, I was thinking that whatever the Treasury sells, investors worldwide will buy it. But when you look at the figures here, it's starting to look more alarming. The last 2 years, 2021, 2022, Treasury sold 1.5 trillion. This year, it's going to be above 3 trillion. We're double that. This kind of snuck in late in the year. Maybe it's somewhat due to a slowdown in tax receipts, which could be a slower economy. But yeah, I think the worry right now is that 10-year Treasury yields could go higher than the market's currently thinking. Everyone's been betting once inflation comes down, the Fed can eventually cut rates and Treasuries won't go much higher because they'll wait for the Fed to cut rates next year. But I don't know, the supply deluge looks like something we haven't seen. We certainly haven't seen it since the pandemic, 2020. All that money during the 2020 that Treasury borrowed, that was sold. But and one of the key things that's pushing up these debt needs, of course, is QT. QT is about 700 billion of it. So out of 3.2 trillion, call it this year, calendar year of borrowing, 700 billion of that is QT. Maybe the Fed should think about stopping QT for a while and letting the Treasury be able to sell this debt to the public without pushing up 10-year Treasury yields.
Chris, even if the Fed does pause either on QT or on broader rate policy in the near term to just see how the economy digests some of that policy that's already been enacted, what do you believe could happen to inflation in this near term as they continue to monitor that and try to continue to watch for a trickle lower to that 2% target? Some have been calling for, or at least anticipating, a resurgence or a tick up in inflation once again.
Well, I think some of the tick up is that gasoline prices at the pump, I think they jumped about 15 cents to $3.75 a gallon this week. So gasoline prices are moving up. Maybe that'll push forward into CPI inflation. We really just got one good month of reading on core PCE inflation, a 0.2% monthly change. If it continued at 0.2%, that would be good for the rest of the year, but there's no guarantees of that. We really just have one good month. So yeah, there could always be an unpleasant surprise there. I hope not enough to derail the stock market rally here.
Oh, we all do. Well, Chris, appreciate the time here on the day. Thanks so much for breaking this all down and adding some insight and context around it. Chris Rupke, who is the Forward Bonds Chief Economist. Appreciate it. Of course, Cool. Have we entered a girl boss economy here? Interest rate hikes were expected to slow demand and rein in decades high inflation, but consumers have been defying all that recessionary talk and continue to spend on tickets for Taylor Swift, Barbie, and Beyonce. Joining us now, we've got Kyla Scanlon, who is the author, educator, and creator. Kyla, have you been to all of these events? Have you already hit the hat trick on both Barbie, Taylor Swift, and Beyonce?
I actually haven't.
Okay.
No, I haven't achieved that quite yet.
Well, some people out there are trying to do it, and I am not in the camp that's achieved all of it either. But what is it telling us right now about the state of the consumer?
It's showing that the consumer has some resiliency. So people are willing and able to spend on big events like this. People are spending about $1,300 on average to go to see Taylor Swift, which I think is really phenomenal. And really impressive just in terms of what Taylor Swift can do. So I think it's showing us that the consumer is willing and able to spend.
Yeah, I mean, well, obviously Barbie and Beyonce, too, to your point, also part of that phenomenon. There is that propensity to spend now. You put out a recent video where you also talked about kind of, does it keep going? Are there other, I mean, Taylor can't, she's not the Grateful Dead or Fish. She's not going to tour forever, right? So at some point, the tour is going to stop and people won't be going to see her. So does that mean that we're going to see spending fall?
Yeah, I mean, maybe. That's one thing that I talked about in the video. I think there's a lot of worries around student loan debt payments starting back up, and if people will be able to finance those, because that's going to be a big hit to a lot of people's incomes. And then I think Taylor Swift was definitely like a summer boost, and Barbie happening at the same time. Like people were just like, yes, I'll go and do all of these experiences. People really want to spend on experiences right now. So I think it'll be interesting in the post Taylor Swift policy era to see what happens. But there are some headwinds that I think we should be paying attention to for sure.
What are those headwinds?
I think the student loan debt repayment starting back up. I think credit card spend, that's always seemingly at a record high. Real wages are finally ticking up, so that could be a bit of a tailwind, I suppose, if I'm using those two terms correctly. But yeah, I think we're just going to see consumers maybe not have as much discretionary income as they did. Yeah.
Do you think that the sort of, I also wonder, like, once you get the fix, I know if you're Swiftie, the fix is never satisfied, right? Like if people can go see her multiple times, they will. But once you've done like your international trip, for example, to just give another example of stuff that people are spending on, I just wonder like how long people's desires and wallets can sustain this kind of stuff.
Yeah, I mean, I guess people said that they would go and watch her again and that they would spend $1,300 again to go and see her. So I think there's the willingness to do it. I do think that we'll probably see a little bit of a slowdown going back into school and going back into the fall. But I think, yeah, once you kind of have that one experience, it might be enough for a while. But presumably consumers could go and spend on other things too. Like there's a lot of experiences out there, but I do think Taylor Swift that whole concert series was just such a boost to local economies. It's really cool, I think, what she was able to achieve within each city that she visited.
I consistently love your whiteboard behind you every time you join us here, and I can see that you map out a lot of things here. And so when consumers eventually do trade down from the $1,300 Taylor Swift ticket or the $900, at least that's the price that I saw, Beyonce Renaissance Tour ticket, what do they trade down to, and who does that begin to benefit in other parts of the spending economy?
Yeah, I think it'll be interesting what consumers end up spending on. People had more cash flow over the past 2 years because of the pandemic and just extra savings. And they weren't really contributing a bunch of that to paying off debt. They were just doing more experiences. So I think there's still, the pandemic was sort of a long time. So I think that people were locked inside for a long time, and there's still probably going to be the desire to consume and go and have experiences. In terms of what people go and spend on, I'm not sure, but there seems to be a desire for travel. Like Southwest Airlines had record revenue. Hilton was talking about how many people are going and staying at their hotels. So I think that there's still going to be people doing all of these things as long as they're able to. Yeah.
And then additionally here, I mean, I'm just looking behind you. You've got travel, flights, airlines, all of this kind of travel and accommodation experience that many of us, for the pent-up demand that we've heard about from airline CEOs, from accommodation CEOs, that they say is still in place. How, for the consumer, do they start to think about, all right, where do we kind of pull back on some of that spending as well in order to monitor where else we've got to either carve down some of that debt that's being incurred on the credit cards, or just to ensure that household balance sheets are still healthy?
I don't know. It's kind of interesting. Like, consumer sentiment is at an all-time high. So it's a little bit confusing to figure out exactly what people are going to do, because people are feeling pretty good. Real wages, as I said, are starting to tick back up. Obviously, credit card debt is at an all-time high. People are taking out loans and trying to finance different things. So I'm not sure what that spending will shift to, or if it'll just sort of stay in this entertainment category. We've seen people really choose to consume services over goods over the past few years since the world sort of reopened. So I think that trend will continue. I can't imagine anything that, obviously there's a lot of things that could prevent that from happening, but I do think that is the way that the consumer tends to be going, is consuming experiences right now.
Kyla, good to see you. Kyla Scanlon, author, educator, and creator. Always good to catch up with you. Appreciate it.
Yeah, thanks for having me on.
We got much more markets action coming. Stay tuned. You're watching Yahoo Finance.
How would you describe the state of the consumer right now?
Yeah, we'd say the consumer is resilient. That is really the best word to describe the U.S. consumer through, what has been a considerable number of challenges. We've had higher inflation, we've had higher interest rates, we've had global economies that have shown signs of softening, but the U.S. consumer continues to power through. And in fact, what we saw in the first 2 quarters in U.S. GDP, personal consumption did go from about 4% in Q1 to about 1.6% in Q2. So we are seeing a bit of softening, but still at healthy levels of growth in consumption. We'd say the services demand is the key there. We are still seeing a lot of appetite for areas like travel, leisure, hospitality. Think about all the vacation planning we're doing this summer. The goods side of the equation, consumption and demand for goods, has softened. And so we think that story has played out over the first half of this year. We may see services demand soften over time, and that could be what we call part of our rolling downturn or rolling recessionary environment. But for now, consumer is holding up well.
Let's do a check of the market sponsored by Tasty Trade right now. And we see all three major averages in a mixed position. The Dow just barely hanging on to a gain here today. NASDAQ taking a hit down by 0.8%, and the S&P 500 kind of hovering there in the middle. All of this coming on the heels of what has been a big up month for stocks, but the momentum is not really continuing today.
Hair's breadth of negative territory for the Dow.
Elon Musk's decision to rebrand Twitter as X was a surprise to many who don't know the backstory. But before there were Tesla or SpaceX, Musk co-founded an online bank called X.com. For more on this, we turn to Daniel Wolf, American banker, content director for payments and credit unions. And that, of course, then was sort of the precursor to PayPal and the so-called PayPal mafia, which included Elon Musk and Peter Thiel and some other folks who have been over there in Silicon Valley for a long time. So what can we sort of learn from X.com and the legacy of that and what it could mean for what he's now attempting?
So what it demonstrates is there is this legacy with Elon Musk where he has this history of creating this internet bank. And this was created at a time when there was a void to fill, where banks were having trouble figuring out how do we get people to use our services to pay for things online. And X.com and eventually PayPal filled that void and was even able to muscle out what the banks were doing, certainly on eBay and there as well. And when they rebranded as PayPal, they kept the X.com name. And for a number of years, if you typed in X.com into your web browser, you would just go straight to PayPal. So they kept that, and they tried to capitalize on it once again later on under eBay as X.commerce, a way to bring in developers to build things on top of PayPal, on top of eBay. And ultimately, PayPal spun off, and the brand name went back to Elon Musk.
And so all of this considered, I mean, how does this set up for what they want to create in a super app and even kind of leveraging that super app as a play for financial service as well?
So if you look at the evolution of X.com and PayPal, it's no financial services company ever likes being just one thing, because then they risk becoming the dumb pipe that other people build things on top of. They want to be involved in that. They want to be enablers. And so you saw PayPal do that when it went off eBay to be in stores and to add services like PayPal Pay Later, Venmo, which they bought through acquisition, and so on and so forth. So with X.com, it kind of signals that this is going to be more than just, okay, I see something on Twitter, I want to buy it. The problem is Twitter's already tried something like that before. They've tried things like turning their platform into a platform for commerce. So people advertise things on Twitter all the time. They advertise themselves, they advertise their work. And if you want to actually pay them for something, you click a link, you go to their website, their Patreon, what have you. You don't necessarily type your payment credentials into twitter.com. Or X.com now. So they've tried that, and it hasn't really turned Twitter into this everything app that Elon Musk wants to try it with, but he did build that foundation for PayPal. Now PayPal still exists, so he's got to contend with that, as his past success is now potentially his competitor, but it demonstrates kind of what Twitter has wanted and what he brings to that as well.
Well, and the other side of it is it's not a nascent technology anymore.
No.
There's not just PayPal and Venmo. There's Square. There's Zelle. There's lots of other ways. There's Shopify that is sort of facilitating payments for e-commerce also. So it seems like it's a much bigger lift now than it would have been then, because now it's just another one instead of the first mover, right?
Exactly. And it's, as I said before, when X.com started, it was filling a void. Banks weren't able to enable a payment. And when we look at it now and today and what they're trying to accomplish, they need to solve a different problem. So what does Twitter or X.com bring to that equation? Well, it brings audience. I want to look at the Apple Card, for example. Whether or not you use an Apple Card, if you're a college student and you want your first credit card. When I was in college, if I needed a first credit card, I would walk around campus, somebody would offer me a free t-shirt, maybe a king-size Snickers bar, and I would hand over all my personal information, and I had a credit card. But now you don't do that anymore. They can't. So if I need my first credit card, maybe it's in an app I already use, whether it's the wallet app for Apple Card or Twitter or Uber or what have you. You see in Singapore, GrabPay, for example, is built on the Grab ride-sharing app. You have WeChat Pay built on WeChat. So if he has the audience and he can hold on to a significant number of people who are willing to put more of their lives into Twitter/X, then that's something that can be built upon.
If I might, it also strikes me as a big if, though, because you look at the much more dominant social platforms. I think of Meta. It would be very logical for Meta to do something like this. They already do a lot of commerce on things like Facebook Marketplace and on Instagram, for example, but there's no intrinsic payment system there, which maybe I'm extrapolating that means it's hard because they haven't done it.
Meta tried.
But I don't know. Meta tried and it didn't really, Libra wasn't,
Libra/DM, yeah. They tried to have a cryptocurrency. They also pitched themselves as a marketplace, kind of like eBay, since they had the ability to take payments from advertisers. They wanted to build on that. And then when they launched Libra/DM, they had the buy-in of major card networks, banks, other players in the financial system. They had all their ducks in a row, but they found that people just didn't want to use, they were skeptical of Facebook. I mean, we all hear a conversation about people saying, oh, I was talking about a particular hat near my phone, and then I saw an ad for it on Facebook or wherever. So there is an issue of trust, and Twitter, no doubt, has to confront those same issues.
I'm so glad you said that magic word, which is trust, because that's something that a University of Michigan professor told us as well around this pivot, around this rebranding that Twitter has made, and even the ambition that they have to have at X, a super app, because at the end of that is the data that somebody's going to have to give up. I'm sure you weren't able to stretch that Snickers bar the same way that a bank was able to stretch the data that you were surrendering to them. And so here, trust comes back into play, and trust for Elon Musk, as well as the combination of different experiences that he wants to bring together. And even if we could see, and I guess the crux of the question here too, even in advance of that trust, you've got a person who's known as the Doge father, who's sent wild swings through cryptocurrency in the past, specifically Dogecoin. Could this be an app where they try to attempt to have a differentiating factor come through via crypto?
Yeah, so obviously, as you mentioned, Elon's, and before I get into that, once I got the credit card, I was able to buy as many Snickers bars.
Okay, that's great.
I could stretch it.
Lifetime supply.
Oh yeah. No, so yeah, there is his relationship with Dogecoin. If you look at his bio on X/Twitter right now, you will see the Dogecoin symbol as his location. So he's definitely still got that attachment to it, and what you said with the valuation swings and so forth. And we've seen other payment companies actually make significant money by being a platform where you could buy and sell and trade crypto. Maybe not so much where you could spend it, but certainly his attachment to it and any affinity that people might have for Dogecoin, that could be something to capitalize on. But again, turning it, there's other companies that do that already. Turning it into something where you're willing to spend your Dogecoin or Bitcoin or what have you, that's been a challenge since the dawn of cryptocurrency. That might be something where we see some revenue from buying, selling, trading, but that's not the only thing that they should be doing.
Yeah, utility has certainly been difficult. Daniel Wolf, thanks so much for taking the time here with us today. Really appreciate it.
Thank you so much.
Absolutely.
A lot of fun.
We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Apple is all set to report this week, and investors are going to be watching that very closely. What type of bellwether could Apple be?
Yeah, look, Apple is one of probably the top company in the S&P 500, close now to an almost $3 trillion market cap. And in fact, it will likely be a bellwether, not only for the tech industry, but also for the consumer. Keep in mind, the iPhone is probably one of the most recognized consumer brands globally. And of course, a lot of investors are curious on the health of the consumer. Now, what we will say broadly on the tech trade generally, we've seen a very fast move very quickly in the first half of the year. Valuations do remain on the high end of the range. Could we see a bit of volatility? Yes, but we do think there's a long-term theme behind tech, AI, and hopefully some of that volatility brings opportunities, especially for those that haven't been involved in this tremendous rally in the first half of the year.
Overstock.com looks a little different this morning. The company has officially rebranded itself to Bed Bath & Beyond, at least in digital form, and after paying $21.5 million to acquire Bed Bath & Beyond, Overstock customers on its Canadian website were redirected beginning in early July. But today, that change expands to the United States. Bed Bath & Beyond CEO Jonathan Johnson joins us now in a first on Yahoo Finance here, officially making the new regional change here in the U.S. Take us into the strategy, the decision-making, the timeline that's going into this.
So we've long liked the name Bed Bath & Beyond. It was an iconic name that was synonymous with home. Overstock, as good as our business model has been, the name really didn't describe who we were. So the opportunity to purchase the name, we tested it in the rollout in Canada for a month. We saw better direct traffic, we saw better conversion, all signs were good. So today's the day in the US that we've relaunched as Bed Bath & Beyond.
Yeah.
And so tell us about what you're seeing already in terms of people coming to the site. And I'm also curious, were people sort of waiting for it? It launched in Canada before. Were people coming to Overstock.com were you seeing an uptick in traffic ahead of the name change is what I'm asking?
Not in the US. We did see a big uptick in traffic in Canada. The other thing that we saw was suppliers who we've long sought to do business with or to have them open their whole catalog to us started knocking on our door, opening their catalog. So since the deal was first announced, we've added over 600,000 new product SKUs in the bed, bath, and kitchen area. So it's a much deeper and broader offering than we had as Overstock. I think the customers are going to recognize that. It's really a great place to shop.
Wait, that's really fascinating to me. So obviously those suppliers needed a marketplace for their stuff that went away when Bed Bath & Beyond closed its physical doors. Are they suppliers that you had tried to get access to before, and now the name change has unlocked that?
Absolutely. Huh. We always felt like we had a wonderful business model, but a boat anchor of a name. Bed Bath & Beyond, great name, outdated, had become a boat anchor of a business model. We dropped the boat anchor from both. We put the two things together, and with both customers and suppliers, it seems to be pretty sleek sailing right now.
Talk to us about that customer experience, because a lot of people who had engaged with the previous brand or the previous iteration of Bed Bath & Beyond, they would say, all right, the digital is great, but what about those physical coupons that I used to get? Those physical coupons, a lot more digital these days now with the transformation. How do you look at the promotional cycles, the customer engagement, where you're going to be able to leverage this name to drive more loyalty even?
So we have always been a high-low retailer, highly promotional, using coupons. We'll continue to do that. For the Bed Bath & Beyond legacy customer that loved the coupons, what they really need to do is download our new Bed Bath & Beyond app. That will be the way that special promotions will be pushed to them. We have today, as people download that, a 25% coupon. That is a big blue coupon that will be in their app. And so I think it'll feel very familiar, both as the products they see on our site and the shopping experience with great corporate deals. Now, I will say this, our pricing has always been a little sharper. So we, beyond this initial promotional period, we probably won't coupon quite as large, but the out of the store checkout will be better deals. I think that's what they'll see because our pricing has been so sharp.
I've been looking at the sort of tea leaves for the home furniture and decor industry. The last retail sales report we got, while it was disappointing overall, saw an uptick in furniture sales. There was just a report out earlier this week from Piper Sandler on one of your competitors, Wayfair, that talked about stabilization in home furniture. Talk to us about what you're seeing.
So what we're seeing is a more normalizing of the seasonal cycle. So, this summer, patio furniture has come back in seasonality like it didn't last year.
Because people had already bought all their stuff during the pandemic.
People had bought it during the pandemic. There was also a glut of inventory last year. So there's a normalizing of the seasonal nature, but the spend is still down a little bit. I don't think we're back to normal. As you were talking earlier in the show about people buying experiences and Taylor Swift and whatnot, that's still a thing, but the market is getting a little stronger in our space.
What would you say of the quality of inventory that you're seeing that consumers are opting for? Is there a trade down even as they're coming back into that spending propensity in home furnishings?
So we make sure we have a good, better, best offering so that people can buy, the price point that they want. But we have seen, over the last 6 months, a slight trade down. If they were better purchases, they're a good purchase now. So that's happening. When interest rates continue to go up, it makes home buying hard, it makes moving hard. All of that affects our industry as home products.
When you look at the expansion of what kinds of products you guys are offering, I would imagine, and I don't know, but I would imagine something like furniture is a higher margin business than some of these more home goods items you're talking about. So what should investors expect from the picture of your profitability going forward?
Yeah, so we mentioned on our earnings call last week that we do expect our average order value to go down a little bit, because you're right, buying a patio furniture set is different than buying a sheet set. And so we expect AOV to go down a little, but we also expect order frequency to increase. And so while we will initially have a big push and spend more on marketing than we have in the past as we rebrand, and that will affect profitability for a time, in the long term, we think this is actually going to be great for both the top and bottom line of our business.
I want to focus on that word beyond as well here, because that really opens up different verticals that you could potentially tap into, and how you brand the corporate culture of the company, how the external culture and how the company is perceived is also taken on. So where do you kind of intend to lean further into the name that has already been recognized and what that appears like in the stock and investing community versus the customer community and different verticals that you launch?
So for now, we're really focused on being a home furnishings and home decor retailer. We're Bed Bath and a much bigger and better beyond, because our product offering is there. But where it goes into the future in different verticals, still be determined. We're really focused on this rebrand and making sure that the home customer knows that the new Bed Bath & Beyond is a great place to shop.
For now, it's still Overstock as the parent company, and the ticker is still OSTK. Any timeline for when that might change?
Julie, we get asked that a lot. It's something that's in the works. I'd like to have it change sooner than later, because I don't like the confusion around the two. We were really focused on getting the rebrand and the website up running as quickly as we could. That's our next step, and I'll have to come back and talk again when we do that.
Okay, that sounds great. In the meantime, I need some new sheets. So I'm going to do a little browsing on
Download the app, get the special coupon. It'll be a great deal.
Coupons are attractive, I will admit. Jonathan Johnson, great to see you as always. Bed Bath & Beyond CEO in a first on Yahoo Finance. We've got much more markets action coming up. You're watching Yahoo Finance.
Has there been one overwhelming theme to this earnings season?
Yeah, I'd say we're about 50% through earnings season, and the theme has really been about 80% of the companies have beat earnings on a bottom line basis. So it does feel like the trend we saw in Q1 continues through Q2. Now, we're still down negative 7.5% or so thus far year over year on an S&P earnings growth basis, but slightly better than expected, and the trend is supposed to improve in the second half of the year. So I'd say net, the good news is we are seeing better margins and better earnings overall in the second quarter.
Shares of Molson Coors are on the move this morning after the beverage maker's sales came in below estimates as inflation continues to batter beer sales. Shares down 6% right now. And Yahoo Finance's Brooke DePalma is joining us now. What's going on with beer? Tell us.
Well, right now, this actually was the single best quarter of net sales since that merger happened back in 2005 with both Molson and Coors. But they did post mixed results here. We see revenue coming in at nearly $3.3 billion, sales rising 11.8%, but that was slightly below Wall Street's estimates. It was led by higher prices, up 9% year over year, favorable sales mix, and higher financial volumes. But analysts were looking for more here. That top line miss was largely driven by sales numbers here in the U.S. America's brand volumes increased 8%. Here in the U.S. specifically, up 8.7%. But analysts on the street really expecting more as other beer companies continue to pull from the downfall of sales of Anheuser-Busch's Bud Light and their other beer brands. Wedbush saying that this came as a surprise given the strength seen in measured channels over the entire duration of the quarter. JP Morgan saying similar, saying that analysts were really looking for even stronger results here. But Molson Coors really saying that in the U.S. they saw growth in their Coors brand being Coors Light, Miller's Light, as well as Core Banquet. They did note a shift in consumer purchasing power, purchasing behavior rather, largely driven within the premium segment. But Molson Coors telling Yahoo Finance this morning that they continue to gain share. They said in the U.S. Coors Light and Miller Light combined were 50% bigger than Bud Light by total industry dollars in Q2 and 30% bigger than that other competitor, Modelo Especial. So really something we're continuing to watch as sort of these beer sales continue to fall out since April.
And Brooke, the company also raised its guidance for the quarter too, and for the year, I should say. What did they lay out there?
Yeah, so right now they're raising their 2023 guidance. They did note in the earnings release that they now expect high single-digit top-line growth and 23 to 26% bottom line growth. But they did note that they're navigating a dynamic macroeconomic environment. Of course, we're continuing to see consumers impacted by inflation. And in addition to that, the CFO did note in the earnings release that they're mindful of that dynamic global macroeconomic environment and beer industry softness. Many analysts looking to the call in just about 12 minutes to really see what sort of consumer sentiment they share on the call. If there's a mix and perhaps consumers trading down pack sizes, consumers once again trading even more so to those core brands. And in addition to that, really looking for perhaps what the second half of this year really looks like. All right.
Yahoo Finance's own Brooke DePalma. Thanks so much for breaking down those results for us, Brooke. Switching gears here, we've got more backlash for Tesla after the National Highway Traffic Safety Administration, you know them in your hood as NHTSA, they announced an investigation of complaints about loss of steering control in certain Tesla models. Yahoo Finance's Pras Subramanian, he joins us with the details here. Hey, Pras.
Hey, Brad. So yeah, another safety issue for Tesla and NHTSA, like you said, investigating 280,000 Model 3s and Model Ys over a power steering loss of control of the steering wheel. Basically, there's 12 complaints. One person said they lost control, hit a tree. So there's been accidents because of this. Another person had to basically just steer into the median, go into a shopping center. So serious stuff here with loss of steering. So this is the first step in a safety probe is the first step before an official recall can be announced. But you know, if you got to replace parts like steering components, that could be a big recall and a big headache for a Tesla.
Now, 12 reports. How is that high, low versus what we tend to see in these kinds of situations?
It's only for so far the 2023 model year, so it's pretty high for one model year. This is only just these most recently built Teslas, Model Y, Model 3 sedan. So kind of a big deal there.
In theory, is this, they like to fix everything through an over-the-air update, right? Where they just like beam it to your car. Is this something, do we know yet if this is something that can be fixed that way?
So reading some of the reports from customers that have actually sent the cars into Tesla, some of these service technicians said this needs an actual physical
like the whole steering column maybe needs to.
Yeah, steering rack, or they use a thing called drive-by-wire, which is basically a motorized, it's not like an actual connection, it's actually just all motors and signals, so they have to actually replace these components, potentially, is what this service tech told one of the customers. So if you're talking about 200,000 SUVs in Model 3, sorry, 280,000, and those all require physical recalls, that's a big deal.
And the one they haven't had to do that before, have they?
There was a recall that just was announced last month where about a few hundred Tesla Model Ys, the steering wheel would come off the actual stock. So that required a bolt fastener. So that's an easy fix, but still you need to go into the actual service area to do that.
This would be much bigger.
Yeah. Also here, shares of BMW on the move today after automaker raised its margin outlook for the year. Frost, you've been tracking this one too. Shares down by about 4% right now.
Yeah, a little conflicting here, Brad, because of the fact that they raised their full year EBIT margin guidance, right? So it's a measure of profitability. But they citing strong order bank and higher sales of premium cars, but they also had to lower their free cash flow estimate because of rising costs due to electrification, supply chain, also inflation that they see coming in the back half of the year. So a bit of a mix there. Investors obviously not happy about that. But we heard the same from Mercedes in terms of the sales of top-end cars, higher-end cars boosting their profits. They raised their EBIT guidance as well. We're going to have the Mercedes US CEO, Dimitri Salakis, on later today to talk about those things. So we'll get a kind of an idea of what the luxury premium segment's doing right now in America and also across the globe.
All right, going to be watching that one for sure. Tuning in to see if they're announcing any price cuts. Maybe.
I know you're a fan.
I know, I am a big fan. Frost, thanks so much for breaking this down for us. All your markets action straight ahead, everyone. Stay tuned. You're watching Yahoo Finance. On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance. A big interview on the docket today. We'll be speaking with the world's biggest hotel chain, Marriott. After it's lifted the outlook for demand on international travel, betting on higher boom in room rates and, yeah, you guessed it, a rebound in China.
International revenue came in better than expected in the second quarter for Marriott, which added over 33,000 rooms globally during that period. The key RevPAR metric, that's known for normal humans as revenue per available room, rose about 13.5% in the second quarter from a year earlier. As for its stateside business, room revenue in the U.S. and Canada was up 6%, and those shares have rallied over 30% so far this year.
Yeah, CFO Leeny Oberg says the consumer is generally holding up well and forward bookings remain solid. Don't miss our interview in the 3 o'clock hour. That's later on today.
And Jared Blickley's got you for the next hour of trading. Keep it right here.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery. Here's what I'm watching. Job openings fell slightly in June to just below 9.6 million. But what does this latest jolt from the Labor Department mean for the upcoming jobs report this Friday? We're going to discuss. And brewing up more earnings after the bell, we'll break down what to expect from coffee giant Starbucks as it gets set to report. But wait, there's more. The latest debut on the New York Stock Exchange. We're going to speak with the CEO of Shark Ninja on the back of its listing later this hour. But first, let us get a check of the markets. And we have been looking at, there we go, it's a mixed day. We got the Dow just barely in positive territory, up about 3 basis points or 10 points. S&P 500 down about 0.25%, and the Nasdaq down about 0.4%. And let's check in on the Treasury market as well, which we've seen some pretty big movements recently. And today it's mostly to the upside. We got the 5-year up to 4.22%. That's an increase of 4 bips. And then we got the 10-year a little bit below that, 4.03%, but that has risen now 7 basis points. So pretty big move there. We're going to be talking about that later. But now the JOLTS report this morning, they showed the number of job openings in June coming in just below street expectations. What does it say about the labor market looking ahead to jobs on Friday? Joining us now on this is Yahoo Finance's reporter Josh Schaefer. Josh, please break down these numbers for us.
Of course, Jared. We got the big number right here, right? 9.58 million. You can see there the estimate was for 9.6 million. Remember, this is the month of June. When we talk about that Friday jobs report, we're going to be talking about the month of July. So this is the month of June, 9.6 million job openings. Ticked down a little bit from May, but largely in line with what we've seen trend. And when you take a look at the trend, you can see the purple line here is job openings, significantly higher than it was before. This is also a great look, Jared. We often talk, you hear Federal Reserve Chair Jay Powell talk about a better balance, right? Yes. We want a better balance between hires and job openings. Hires is blue, so hires not necessarily ticking up, staying right in line here. Job openings starting to come back down there, but for that better balance that Jerome Powell talks about as well, the Fed probably wants to see job openings continue to come down significantly more than we've seen thus far. And then finally, to close out here, we can't talk about the labor market this week in the first week of August without talking about the July jobs report that is expected on Friday. Here's what we're looking for. 200,000 non-farm payrolls. That would be a slight decline from what we saw in June. Unemployment rate roughly flat. Average hourly earnings to come down a little bit to 4.2%, and the labor force participation rate at 62.6%. Again, a key thing to look for here is, does this number come in below what economists are projecting? So would it show more of a slowdown in the labor market? That would be a key indicator. Does average hourly earnings come in lower than expected? So are people earning a little bit less? That is key to this fight against inflation and is a big focus right now in the overall economy, because this strong labor market, it is what is driving that consumer spending that we're seeing. And that's what becomes the long-term concern when we talk about the fight for inflation.
All right. Thank you for that report, Josh. And we got to keep the dial here on Jobs Day. It's coming off of last week's Fed decision. And there's a lot of focus on the strength of the labor market. So joining us now is Alfonso Peccatiello, the Macro Compass founder. Alf, great to see you here today, as it always is. Tell us, what's something that investors should be looking for when we get this big report on the jobs numbers this Friday?
Look, Jared, first of all, always a pleasure from my side to be here on Yahoo Finance. The thing that investors should look the most for when it comes to Friday's jobs payroll report is the cyclical industries in particular, because any slowdown in the job market has generally been anticipated by cyclical industries underperforming when it comes to hiring trends. So we're looking at stuff like the construction sector, manufacturing, trade, any kind of cyclical sector in particular needs to be scrutinized pretty closely. Now, construction has been one of the major upside surprises in the job market this year, because as the housing market seemed to have slowed down late last year, beginning this year, one should historically expect construction hiring also to decline, and therefore the job market later on to decline more broadly. That hasn't really happened yet, and it's definitely an area of focus if you're looking at the non-farm payrolls numbers on Friday.
All right, I want to move on to the Federal Reserve. Just had a big decision last week, and I have a chart on the Wi-Fi Interactive. We got this from you, so it should be pretty familiar. This is Powell's favorite inflation measure. This goes back to 2013. U.S. core services taking out housing, and this is 6-month annualized. You can see here, I'm going to circle this peak here in June of last year was 7.5%. It has crashed now to 3.3%, which is where we are now. Just tell us the significance of this and how the Fed might be thinking about this number.
This is very relevant, Jared, and for clients of the Macro Compass, I like to plot this chart even on a 3-month annualized basis. If you do that, the stickiest subcomponent of inflation that Powell himself referred to, so core services ex housing, is annualizing at 1.4% on a 3-month basis. So the sticky part of the inflationary pressures has really subsidized by now. And you have heard Powell as well in the last press conference for the first time talking about potential Fed cuts coming not when core sticky inflation is at 2%, but once core sticky inflation starts to become credibly on its way to 2%. That might happen way earlier than 2024, 2025. Actually, by the chart you showed, it's already happening. So this idea that the Fed will only cut if a recession comes, that the Fed will wait for inflation to get to 2% before cutting, I think it's a bit too far-fetched. The Federal Reserve is not the Bank of Brazil. It's not an emerging market orthodox central bank. They will look at cuts if core sticky inflation continues on this downward trend in 2024.
All right, so if core inflation is convincingly on its way down to 2%, let me just show another chart that we have here on the Wi-Fi Interactive. This is U.S. growth, nominal growth, versus the federal funds rate. This goes back to the early 2000s. Just tell me what we're seeking, what we're looking at here, and then maybe explain these dips below the purple line. The purple line is the U.S. Fed funds rate, that is a Fed's a benchmark rate, and the cyan line is U.S. nominal growth.
Yeah, Jared, basically the point of this chart for my clients was to show them that every time you get U.S. nominal Fed funds above the trend of U.S. nominal growth, you're looking at empirically tight policy. So policy is biting. And you can look at 2007, which are circling right there. You had U.S. Fed funds over 5%, and nominal growth in 2007 was trending below 5%. And then you look at it today and you have Fed funds at 5.25 and US nominal growth on a 6 months annualized basis is about 3.5%, 4%. So again, you have Fed funds above the trend of nominal growth. When that happens, historically, policy is tight, policy is biting. And don't forget, the macro lags of policy having already been tight for 13 months and counting are obviously coming to bite. I think this is one of the reasons why Powell, but also other central bankers, see the Reserve Bank of Australia last night, are more hesitant at this stage. They won't really be super aggressive because they understand policy is empirically tight and the lags are also about to kick in. The risk now is that policy has become too tight.
And one more chart. I don't know if we have this, but I'm just going to describe it. You label it, what's the path ahead for U.S. equities? And it takes a look at the U.S. 10-year real yields, so that adjusts for inflation, and you compare it to the S&P 500 trailing earnings year, and that is earnings yield, and that is the inverse of PE. So explain what we're looking at right here and the significance.
So look, basically, when you look at equity markets, what you're looking at today is a situation where analysts are revising higher their expectation for earnings. You have earnings expectations for 2024 at plus 10 to 12%. It's a pretty solid earnings expectation considering that policy has been tight and remains tight. And then you're looking at valuations at about 19, 20 times forward earnings at a point when risk-free real interest rates are pretty elevated. In other words, we're effectively pricing equity markets to be picture perfect here. And obviously you can rally another 100 and 200 points, but my point is that both from an earnings expectation perspective, things have become more rosy, but also from a valuation and a risk premium perspective, things look pretty tight and optimistically priced as we speak.
All right, I want to switch gears. We got time for one more. Got to talk about Japan and a little mess they might have created over there. I want to draw everybody's attention to the Wi-Fi Interactive here, and I'm going to show what's been happening with the yen. This is a year-to-date heat map of all the yen pair crosses, or some of the major ones. What's green, the yen has appreciated versus the Argentine peso, 42%, but that is it. And it is devaluing against a host of other currencies. Here is a chart of the the yen, US dollar versus the yen, and it is right up to historically pretty high levels. That's a year to date. And I'll just switch this out to a 10-year chart, and you can see right there. So what's the significance of what's going on over in Japan right now?
So look, the Japanese yen is a funding currency, as it's called in currency carry trade. So basically, you short the Japanese yen because it's very cheap to do so. Interest rates have been so low for so long, and you go and buy some other currency that yields more, right? And effectively, we had a little bit of a change in paradigm there when we thought that the Bank of Japan would change its yield curve control policy and allow yields to get higher. So you would expect an unwind of that trade. The reality is that we are now in August. And so far, the new governor, Ueda of the Bank of Japan, hasn't really changed much. And even the last announcement is not really that significant because the Bank of Japan basically said, look, we are going to allow 10-year interest rates to move up higher than 50 basis points, all the way up to 100 maximum. But by the way, if the process becomes too vicious, we are going to stop everybody out. We're going to come into the market and buy bonds again. That's not really a very hawkish statement, isn't it? So you go back to an environment where the Japanese yen is not necessarily the currency that investors want because it doesn't provide you with any yield. Actually, you want to try and sell the Japanese yen to buy other currencies like the Brazilian real, which is still yielding over 13, 14% over there because the Bank of Brazil keeps rates very high. And that's this, tug of war basically between weakness in the Japanese yen and Japanese authorities on the other end trying to stop the weakness. But until they act decisively on the yield curve control, that's not going to stop.
No credibility, at least as judged by the markets so far. And one of my worst nightmares in the markets is a disorderly unwind of this carry trade, which has gone on forever, decades. Got to leave it there. Always appreciate you stopping by. And Alfonso Picatiello, the Macro Compass founder. Nikola stock on fire, up over 500% in the last month after crashing 99% from its $94 high in 2020, short after its listing. Now, fueling the move, Nikola just got an order from J.B. Hunt to buy 13 zero-emission trucks, of which 10 will be battery electric and 3 will be hydrogen fuel cell. Now, delivery is expected this month, and also boosting shares is a $16.3 million grant that the EV maker was just awarded to support 7 open network hydrogen fuel stations. This brings the 30-day total for this spending to $58 million. And you take a look at the stock, still somewhat of a penny stock, trading as low as 52 cents recently. Nikola is now trading at $3.12. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Is recession still on the table? It seems like soft landing is purely in the cards right now. Is that true?
Yeah, look, we couldn't have asked for a better Goldilocks type scenario, at least for now. We're seeing inflation moderate, and that's not only headline inflation, we're seeing early signs of core inflation moderate. This comes even as economic growth is holding up better. So you can have an environment where growth in the US is still in that above trend 2.5% range, inflation moderating, and by the way, earnings holding up better. And we have a Fed that potentially, and really global central banks, thinking about stepping to the sidelines. We do think this year, pivoting lower to rate cuts unlikely, but next year, the Fed has already told us that they may be considering cutting rates. So you have an environment where interest rates may be headed lower, inflation is trending in the right direction, and growth is still holding up. That to us is a soft landing.
Let's do a quick check of the markets, sponsored by Tasty Trade. Everything in the red now. The Dow just barely. S&P 500 down 1/3%, and the Nasdaq down an even 0.5%. In light of uncertain economic outlook and interest rate hikes, U.S. banks are reporting tighter credit standards and softer loan demand. That's according to a Federal Reserve survey out yesterday. Let's bring in now Yahoo Finance's David Hollerith to discuss more. David, the details, please.
Hey, Jared. So the Senior Loan Officer Opinion Survey, or SLOOS, has gotten a lot of attention lately. And, what we've seen from the second quarter, the results showed yesterday, is that banks continue to tighten their standards for making loans to businesses and consumers, and they expect to continue to tighten those standards for the rest of the year. Now, this isn't a huge surprise. It's largely what we've seen in earnings from the larger banks over last month. But it is important, obviously, as Fed Chair Jerome Powell did speak to this last week at the FOMC meeting, and he, pointed out that conditions are tightening and they should continue to tighten. And banking credit, bank lending is sort of one kind of partial indicator we can use to gauge a recession. So from the survey, the share of banks that said they're making it more difficult for consumers and businesses to borrow money is still growing from last quarter. That's sort of the main takeaway. On balance, standards have tightened across most businesses and consumer loans or consumer lending. And that's outside of demand for credit card, which has remained unchanged, or I guess you could say pretty resilient from last quarter. Now, on the tightening standards, looking to the end of the year, the banks cited an uncertain economic outlook, deteriorating credit quality of their loan portfolios, concerns about bank funding costs, as well as deposit outflows. Some also said that they're anticipating the new rules, which were proposed by regulators last week, may also restrict future lending. So again, slowing bank lending can serve as a recession indicator, but it's not always a clear one. And the broader economic implications of this could potentially not be felt for at least a year and a half. So it's a very slow moving thing we're looking at now.
Yeah, another lagged effect that we have to worry about. Shifting gears just a little bit, crypto shares taking a hit, and I want to bring up the Wi-Fi Interactive here, and that's involving a ruling in a case, and this is a different one, involving Terraform Labs, and that's different from the Ripple decision that we got the other week. This is the crypto stocks board. Here's crypto, and I just want to show what's happening in Ripple here. Here's a 2-day chart. We got an up move and a down move. A little curious though, but you take a look at the year to date, still holding on to that gain, that huge gain, a lot of those gains that we got earlier in the month, David. So what's this latest ruling about?
Right. So this was actually a decision in the court. It was a court case between the SEC and Terraform Labs yesterday afternoon. And the legal judgment made in the Southern District of New York by Judge Rakoff contradicts the ruling made by rejects the ruling made by another judge in the Ripple case last month. And so what we're seeing here is some contradiction in the courts. This case with Ripple last month was sort of heralded by the crypto community as a win in terms of whether or not a cryptocurrency might be considered a commodity or a security. Now, again, in these two lawsuits, we're looking at two different cryptocurrencies. So that's one difference. But overall, the decision that was made by the judge in this court case yesterday sort of underlined the fact that the prior ruling they did not agree with. And so it sort of takes us back to the drawing board in terms of how to interpret what the court's decisions might mean for crypto regulation. So differing legal opinions, I've spoken to lawyers who are involved in securities law and also involved in the crypto space. And what they're saying essentially is that, expect to see continued murkiness in terms of what some of these judgment calls will mean for how cryptocurrencies are classified until Congress acts. So that's been sort of the latest interpretation I've heard of that. Another thing I do want to point out is that a DeFi platform, Curve, was actually hacked on Sunday evening. And there's been growing concerns over the confidence for that platform. It's a major DeFi platform, and that could also be contributing to some of the sell-off.
All right. All of this underscores the fact that, as you said, we don't have congressional legislation on this or even clear interpretive guidance from the SEC. So we'll be waiting for that, I'm sure, on pins and needles. Thank you for that, David Hollerith. The market has been pricing in lots of commentary from corporate earnings releases and the Federal Reserve's latest rate hike as we enter the month of August. The S&P 500, it finished the month on a positive note, up 3.1%. The NASDAQ added 4.1% for the month. According to our next guest, the third round of inflation is on its way. So let's bring in MarketGauge.com Chief Strategist Mish Schneider to discuss more. Mish, always great to see you here. Another round of inflation around the corner. That doesn't sound like something a lot of people are expecting.
Well, we're really looking at the energy and oil market because a lot of the numbers that have come to date really had shown a decline that we saw in energy and oil. And of course, that was a very celebratory reason to think that inflation had cooled and would stay cooled. But what we're seeing now is just the reverse. The CRB has gone up, and the oil market has inclined about 15%. We're trading at around $81 a barrel right now. And that $80 a barrel was a really key area. And of course, we have many, many stories, not just because of OPEC plus, but even here at home with the reserves being extremely low and demand being greater than what they thought. So I'd say that before I would go in full hog into this prediction, we have to continue really to watch what's happening there with oil, because regardless of the yields going up today or the dollar going up, we know that there are factors in commodities that ignore all of that when we come into a real supply-demand situation. So that's kind of what we have our eyes on right here.
All right, what I have on the interactive right now, this is WTI crude oil. We're just looking at that. I want to show everybody the S&P Goldman Sachs Commodity Index. This has been for a while, and you can see here just breaking through its negative trend line. I think it's above the 200-day moving average as well. There you go. What's the importance? What's the significance of this for markets in general? Because a lot of times this just spells more inflation, something we've been talking about.
Well, it's kind of, I think we're at a really interesting spot here in terms of the consumer, and we can certainly talk about that sector in a moment. But we have a situation now where the yields have gone up, obviously, right now. People were looking based on what Powell said, and I've certainly heard many, many people talk about the potential pause or possibly pivot in 2024. But essentially what you've got right now is folks feeling it from two areas. They're feeling it not only from an inflation standpoint, and prices have not really come down very much, at least that I can see when we go out just basically to a supermarket or for anything for that matter. And we have a lot of commodity prices still high, cotton being one, food prices still being high on many levels. And two is now with the higher interest rates, you're pinching people two ways. They're going to pay more in both ends, what they borrow, their credit card debt, and even what they pay, even if they're paying with cash in terms of inflation. So that to me is somewhat dangerous, because that means that the Fed, before they start cheering soft landing, have to worry what's going to happen over the next 6 months if these things we're talking about actually continue to go up. And I'd say energy is probably the biggest area, because that impacts everyone. As much as we like to think we're in a total EV world, we're not.
Sure.
And so people still rely on oil and gas. And seasonally right now, we've had a lot of grid problems because of the extreme heat. So all of this is in my mind constantly. And I think that's really what we have to watch now, is if this CRB continues to go up, what all these numbers that we've seen soften over the last few months will start to rise, and how aggressive the Fed gets when they're already pinching and knowing the economy is growing basically because of a lot of government spending and consumers now still cheerful. Go ahead. I'm sorry.
I just want to get to some tickers here so we can put your charting skills to work. I've got all the tickers we talk. I can go transportation, regional banks. You just go and I will outline here and I'll be your graphics operator.
Okay, well, yeah, I mean, and I'm sorry to go on a rant, Jared.
No,
it's just
okay.
that I feel very passionate about people being careful right now, getting too complacent.
Very good.
Right. Okay. So there we go. All right. So let's go with my economic modern family, right? Because that has always been my guide technically. So we can start with the Russell 2000 because I think that's key. A lot of people anticipated that we might see a little bit of softening in the tech and growth stocks in the NASDAQ and see some of that rotation to value. And of course, that would be a better sign for the economy. And right now, that's not so terrible to think because IWM is actually doing pretty good. It is somewhat outperforming the SPY. That's always a good thing. 193 was a key breakout on a 2-year business cycle. The only thing right now is the momentum is declining, but there's no real divergence between what we're seeing in price and momentum. So right now we could just say, yay, that's a good sign that we can notch up today's redness as just a normal amount of correction that one would expect after so many green days.
All right, a key constituent of the Russell 2000 small caps is the financial sector. Regional banks been under huge pressure this year, but we've seen them surge recently. I'm going to put up a chart of KRE, that's the Spider S&P Regional Banking ETF. And what are we seeing here? We haven't quite made it back to that breakdown level from earlier in the year. In fact, we got quite a bit of space in there.
Right. Actually, 52 would be a really good area to clear to prove that we can actually get above all of that resistance that we had before. But right now, again, this is actually also outperforming the S&P 500 right now. That's kind of an interesting sign that the banking is doing better. But on the momentum, once again, with this being red, we're seeing a slight possibility of a mean reversion here. So I'd say some kind of correction would not be crazy. It wouldn't necessarily mean tremendous weakness. But, we're watching around that 44 level to really hold our 44, 45. And if it can get through 52, that should be a nice rally in a lot of these banks that were basically written off as dead.
Yes, and we're going to be on alert for signs of inflation here, at least open to the possibility. Thank you for that, MarketGauge.com Chief Strategist Michelle Schneider. All your markets action is ahead. Stay tuned. You are watching Yahoo Finance.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
Starbucks, the stock trading down about 1% there. That's ahead of its earnings. The company is going to post third quarter results after the closing bell today. And here with what we can expect from the report is Yahoo Finance's Brooke DePalma. Brooke, the numbers, please.
Yeah, good morning, Jared. I mean, it's really expected to be a strong quarter for Starbucks as they continue to have pricing power over consumers, and then international growth, a bright spot there as well. Adjusted earnings per share expected to come in at 95 cents. Revenue expected to be well above $9.3 billion, according to Bloomberg consensus estimates. Some drivers there are expected to be that return to the office, their increased speed of service from the reinvention plan that they announced last September. And in addition to that, as I noted before, that international growth. But let's kick off here in North America. Overall, though, North America and international same-store sales expected to increase 11.12%. Here in North America, sales are expected to be higher as well, up nearly 8.2%. In the U.S., up 7.7%, driven higher by that higher transaction as well as higher ticket size. Now, that is a tick lower compared to last quarterly results, so perhaps a bit of pullback here. But in the U.S., foot traffic continues to outpace its competitors, beating Dunkin' as well as Tim Hortons, according to foot traffic data analytics company Placer.ai. And some notes out ahead of this earnings report after market close today on Tuesday. Nick Saden of Wedbush said that he expects increased traffic due to that return of office trends and the improvement in speed of service. But he also expects a sales lift from food sales and continued strength in both delivery and mobile orders. And Sharon of William Blair, another analyst on the street, saying that she expects no pushback here to higher prices that the company took at the end of last year. We do expect those higher prices to normalize a bit. Rachel Ruggieri last quarter telling us it should go back to about 1% to 2% this fall. But she said that when she spoke to management in early June, they indicated no sign of a softening macroeconomic environment impacting the company's U.S. business or any change really in consumer behavior. So, Jared, the big story here, Americans continue to pay more for their lattes.
I'm not surprised there. What about, though, Americans abroad or just the international scene overall? Because we know, and you mentioned this, that China off to a slow start this year, that reopening really not as big as people hope. But what are we expecting for Starbucks?
Yeah, well, over the course of COVID, Starbucks really did invest in their international and specifically their China business. They had their 6,000 store opening last year. But as you can see here, international growth really led by China here. An extraordinary up nearly 42% same-store sales growth expected for this quarterly report after market close. Of course, in China, we're expecting to see further improvements as those COVID-19 lockdowns continue to grow in the rearview mirror. In addition to that, analysts really expecting a stronger transaction size here, up nearly 23%. They're also expecting an 8% increase in the average ticket size. And so really something to look out for as these consumers flock to these Starbucks stores to get a taste. Perhaps, also looking out for other things like the afternoon day part that we're seeing in international growth, how exactly consumers are interacting with this store growth there.
All right. After the bell today, 4 p.m., we're going to be with us. All right. Brooke DePalma, thank you for that. And don't miss Yahoo Finance's interview with Starbucks CFO Rachel Ruggieri. She can tune in tomorrow in the 9 a.m. hour. All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
Has there been one overwhelming theme to this earnings season?
Yeah, I'd say we're about 50% through earnings season, and the theme has really been about 80% of the companies have beat earnings on a bottom line basis. So it does feel like the trend we saw in Q1 continues through Q2. Now, we're still down negative 7.5% or so thus far year over year on an S&P earnings growth basis, but slightly better than expected, and the trend is supposed to improve in the second half of the year. So I'd say net, the good news is we are seeing better margins and better earnings overall in the second quarter.
The IPO market has been showing signs of life again. Leading the charge has been Kenvue, Kava, Super Value Village, and Kodiak. Investors have been excited about them, although they haven't proven to hold much weight in the market. Yesterday, Shark Ninja, a lifestyle and kitchen appliance producer, was another company that joined the growing list, going public on the New York Stock Exchange. The company spun off from JS Global with the household appliance company seeing $3.7 billion in net sales during 2022. Let's bring in now Shark Ninja President and CEO Mark Barocas to discuss with us. I was there yesterday for the festivities down at the New York Stock Exchange. Great, nice large crowd, by the way. Why come public this way? It wasn't a traditional IPO. It's a spinoff. Just give us a little background.
Well, we've been a Hong Kong publicly listed company. We've been a subsidiary of Hong Kong publicly listed company, JS Global. But we think Shark Ninja has a great story to tell, and we think the New York Stock Exchange is the right place for us to tell that story. We're a highly diversified consumer products company with nearly $4 billion in revenue. We've got a great profitability profile and a strong demonstrated track record of organic growth. In fact, our business back in 2008, 15 years ago, was under a $200 million business, and during all of that period of time, all of our growth has been organic. We've never acquired a dollar of revenue.
And Sue, do you do your, I guess, inventing your product development, all of that is in-house then? And let me use this opportunity to, you can tell us, what other products, because I know the Shark, I know the Ninja, what else do you guys have?
So we go to market under two really well-respected brands, as you said, and multi-billion-dollar brands. Shark is a market leader in cleaning, floor care, home environment, and beauty. Ninja does just about everything in and around the kitchen and now goes outside the home with our outdoor cooking products. We're in 27 different product categories. We sell in 25 markets around the globe. All of our products are developed in-house, by our engineering team, both in Boston, in London, and in China.
I assume you have your finger on the pulse of the consumer here. I'm wondering, what trends have you noticed as we emerge from the pandemic? All kinds of things are going on, but what are you seeing from your vantage point?
Well, look, we have a large team of ethnographic researchers, and that's a big driver of where our ideas come from, is trying to identify either known or unknown consumer problems. And then we have a team of over 700 engineers around the world in all facets of engineering, mechanical, electrical, software, mechatronics, app IoT, that's working to be able to develop innovative products to solve those problems. Trends that we see, consumers want more multifunctionality. They want better performance, but they also want extraordinary value. And we think that Shark Ninja really brings that whole combination to them.
I'll say simplicity too. I happen to be a Ninja owner, and I appreciate the fact that I can get things done with one button, if that's all I know. But tell us, what do you have on the horizon here? Anything exciting? You don't have to share, spill the beans on all the secrets, but areas that you might be going into, new ones.
So I'll give you just a few examples. We launched into the beauty business. We have a product called the Shark Flex Style Hair Styler. You can go onto TikTok or Instagram. It's doing fantastic and getting really great reviews. We entered into the outdoor cooking business with our Ninja wood fire products, both a grill and an oven. Again, giving you multifunctionality, outside the home as well. Consumers had such a great experience with Ninja products in the home. They're now willing to give us a chance outside the home. And just last week, we launched a new product called the Ninja Thirsty. It's an at-home beverage maker. It makes still or sparkling drinks. It allows you to be able to dispense just a cup, and it makes 20 different types of drinks. So lots of different products and lots of different categories.
All right, want to end on a slightly serious note. We talk about inflation and the potential for recession here a lot. Anything you're seeing that points to a slowdown in the consumer, or is the consumer just roaring strong still?
Well, look, we're obviously, conscious of the inflationary challenges that the consumer has faced, and we do everything we can with our global supply chain to make sure that we're keeping prices down and we're making affordable, accessible innovation for consumers. Consumers are going to continue to expect more. If they're going to part with their hard-earned money, it really needs to be a product that they love and that they think they're getting extraordinary value. And so we think if we can keep delivering it, they'll keep choosing Shark or Ninja.
All right, we have to leave it there, but I really appreciate you stopping by. Shark Ninja President and CEO Mark Baracus.
Thanks so much.
All right, the Federal Reserve, they raised rates last week for the 11th time, just before a cooler inflation report on the Fed's favorite inflation game. Wall Street thinks the central bank should be done raising rates, even as officials have penciled in one more hike this year. Yahoo Finance's Jennifer Schonberger spoke with Chicago Fed President Austin Goolsbee for more on that next move. Take a listen.
It was fabulous news to get inflation, to see that inflation's coming down in this way. And it's important to note there's different ways you can view inflation, and we tend to look backwards over the last year. But the new information, of course, is just the monthly reading, and the monthly readings have been coming in quite good. So our goal is to stick on what I call the golden path, which is let's get inflation down without causing a major recession. And that will be a triumph for the Fed, a historic triumph. It's very seldom happened that way. We've never been able to get inflation down even as much as we've gotten it down so far without a recession. So the restrictiveness of the policy rate, we're gonna have to play by ear, and we'll get several more major data points before the next meeting. But it's looking like we're walking the line pretty well.
Okay, I want to come back to that in just a second. But before that, last time you and I spoke back in May, you were worried about the early innings of a credit crunch. We're now more than 4 months since the failure of Silicon Valley Bank, other regional bank failures. How do you view credit conditions now?
So far, that's been the dog that has not been barking. So we've seen a stabilization in the bank sector. We've seen money coming back into bank deposits. Whenever you get a rate tightening cycle like the one that we've experienced, where we're up 500 basis points, in 15 months, let's call it, that will mean tighter credit conditions. But so far, we have not seen anything tighter on the credit conditions than what you would expect for such a tight rating cycle. So that's been heartening to see.
Okay, so you mentioned things are looking pretty good on the inflation front. You got that better PCE number, the better CPI number. The dog hasn't barked, like you just said, on credit conditions. So how much more work do you see left to do to really bring inflation down from here?
Well, that's the key question. Thus far, I think we have been disproving the folks that have let's call it a stable Phillips curve in their mind, that the only way to get inflation down is to crank up the unemployment rate and engineer recession. And there are a great many economists who have been arguing that. The last 6 months have proven that wrong. And the stable Phillips curve idea was kind of broken before there ever was COVID. And now we're coming out of COVID and it's broken again. And as I say, two brokens do not make it fixed. I think let's follow the data. And this business cycle was so sufficiently strange and sufficiently unusual that I don't think that the normal rules of a direct trade-off between unemployment and inflation necessarily have to apply. They certainly have not applied in the last 6 months.
So to your point, given the resiliency that we're seeing, does that still allow you for more room to do one more rate hike later this year?
I don't know. As you know, Jennifer, I'm not a fan of tying our hands before we get the data. We still have months before the next meeting. I will say thus far, we're on the golden path. And we got to walk that line. We're going to stick to it. But that effort to get inflation down thus far is working. And if we can do that without generating a major recession, that's a big achievement for the Fed.
You've been a fan of moving more cautiously. Do you feel it would be prudent to skip the September policy meeting to allow for more time to collect data and then decide whether you would want to raise rates again later in the fall?
I don't know. It's a hypothetical. We're going to get multiple important observations about both inflation and the job market between now and September. And I'm open to reading the data. If there's a major change of conditions, I haven't made up my mind for what should happen in September, but this golden path, which so far we're sticking on that line, that would be a triumph, and it's certainly a possibility at this point.
Certainly a possibility to skip September or to stop raising rates if you have enough good inflation by September.
As I say, all of the above. There's nothing off the table. There's nothing specifically on the table. Let's not tie our hands of what we're going to do before we get the information. So far, we've gotten inflation down without a recession, and indeed without even raising the unemployment rate, a thing that many economists said was literally impossible. So let's keep our eye on the new monthly inflations in core, both goods and services and housing, because the goods inflation, we've seen nice progress. Housing is now supposed to start dropping. The housing inflation is supposed to start dropping as we get the market rents kind of flowing through into the way the index is calculated. And anything that we're getting in the near term reducing services inflation is in a sense just an added bonus, because we have not thought, we have always thought that to be the stickiest part of inflation. That we've seen actually some progress on that front was unexpected and a nice bonus.
So in order to move into that extended hold, if we were to get a couple more readings on core inflation similar to the last couple that we received, would the data suggest stopping?
Well, you saw the median SEP at an earlier Fed meeting. And I will just point out the market expectations about rates are pretty similar to what's in the SEP, even a little less aggressive. And yet the market expectations of inflation are firmly anchored right around the target. And that's what you want on the golden path. And it doesn't forecast a major recession to do that. And that will be a triumph. If we get to that and we come into September on the golden path, I think everybody will be feeling good about where we are.
All right, so maybe that could have marked the peak then if we continued on this golden path, then it sounds like. Then kind of looking ahead, eventually as you look to hold rates for some time at certain elevated levels, as inflation comes down, how will you judge whether the policy rate has become too restrictive and needs to be trimmed?
That's super important. That's the balancing act of walking the line, is that once you find the golden path, you got to stay on it, and you got to just keep monitoring the new information. Now, I've seen a lot of people trying to emphasize wages, almost treating it like it's a leading indicator for price inflation. And the only thing I will observe is that historically it's not at all. Wages lag price inflation. They're not a leading indicator of it. So I would caution everybody, don't make too much about inflation prediction when you see what wages are doing. It's more like what's happening to price inflation today is the indicator of what will happen to wages 6 months from now.
That was Yahoo Finance's Jennifer Schonberger speaking with Chicago Fed President Austin Goolsbee. Well, today's chart of the day, we are looking at the VIX, and this is seasonality. So you take an average of what the VIX has done over several decades, you plot them in a one-year chart here. This is what you get. And what's really interesting, by the way, if you're wondering where we are here. And this is actually right at the beginning of August. And you can see that this is the beginning of what happens usually is an uptrend in volatility. An uptrend in volatility usually almost always means down stock prices. And one of the reasons for this is because the average is skewed over the years by a number of September and October market crashes. It doesn't mean that stocks have to go down, but it means every once in a while there's a big crash, and we've seen a number of them occur in this time frame. So we want to keep open to that possibility. Also, we get one of these spikes in January to February. And I'm just going to show you what the VIX has done so far this year. Pretty interesting because we are kind of tracking the same price. We got this big spike up in March, not February, so it's a month late, but that had to do with the iBank panic, and that was the internet bank panic that we saw that involved all of the regional banks. So what stands out on this chart is we are all the way back down at the lower right. 14 handle for the VIX is very small. It's a very low number. And you can see, you take a 3-year chart, you'd have to go back 5 years to get to the prices or get to the levels that we're seeing VIX right now. Now, the VIX is a non-trending asset. It's mean reverting. So if it goes up, it tends to come back down. And the biggest thing for the VIX is you can buy protection, but it gets very expensive when you need it. You want to buy it when it's right here, when you don't need it. All right, let's do a final check of the markets, and I'm going to go to our indices, our global map here. It was a mixed day, but you can see everything now in the red. The Dow down just barely. Nasdaq off about 1/3%. Small caps, Russell 2000 down about 1%. And I want to check in on our heat maps here. Let's go to our intraday look. And there we go. We got tech and industrials. Those are the only two sectors in the green. Rounding out the bottom, we got energy, consumer discretionary, that's retail, and utilities. So interesting mix here. Not going to make too much of the price action. We're going to have to leave it there. That's it for now. I'm Jared Blickery.